It's all private.
It's 10 o'clock.
But, you know, it's all for.
Okay.
Small
Good morning.
firms, people like McCrae's.
It's
would have
10
benefited
o'clock,
from it.
time to start the Defined Contribution Committee. And I think first up, we have Callan, but if you want to give any remarks, or you first, we can get going.
No, sir, Mr. Chairman, thank you. Good to see everyone, and we can go ahead and get started.
Good morning, Mr. Chairman. No opening remarks from me for this committee. We have Alex Ford here with Callan set to give us an overview of the MDC and ORP performance.
Welcome.
Well, thanks, Charles. Good morning, committee members. Great to see everyone. Great to be here in Jackson with you all again. So first up, we're going to cover the MDC. This is an update through the end of 2024, and we'll take a look at the ORP. If there are questions along the way, please stop us. We're happy to answer questions or go into detail where needed. If you have the MDC book and flip just a couple pages behind the cover, I believe it's page 4, it says Capital Markets Review. Just going to hit some of the high notes on the market environment through the end of the year. We'll cover this in much more detail when we talk about the DB a little later on. But broadly, broad strokes, the fourth quarter was a bit of a mixed bag. On the one hand, the U.S. stock market continued its upward trend, another positive quarter and very strong year. So the S&P 500 gained 25% for the full year. That was after the prior year when it gained 26% in 2023. So we've had a couple of really strong years for equities. It's been great for saving, great for investing. And that dominant performance, as we'll see, was really led by large cap stocks, particularly growth stocks. That Magnificent Seven cohort you've heard us talk about in the past is still really fueling, a lot of the performance. And so with that comes this concept of index concentration that we've also talked about, where a few names are really driving most of the gains. And there are risks to that, but at least for people investing up to this point, they have reaped the gains of those strong markets. Now, in fixed income world, it's been a little bit of a different story. The U.S. bond market faced challenges in the fourth quarter, and that was really as yields rose. And so as yields go up, bond prices come down, negative total returns. Bonds still managed to eke out a modestly positive return for the year, so that's good. But as we'll hear about later, investors in the bond market are really trying to figure out where inflation is going from here and what the path for the Fed might be in terms of future rate cuts. And we'll flesh that out in just a moment. The Fed did deliver on a full 1% of easing to short-term rates in the latter half of last year, kind of as expected. So yields on the short end came down, yields on the longer end were pushed up as, again, people were repricing this concept of resilient growth, strong consumer, strong economy, potentially higher inflation, continued fiscal borrowing. So with that came kind of an uninversion, or at least the beginning of one, of the yield curve, something we've kind of been waiting for a couple of years. When we talk about equities outside the U.S., both developed and emerging, they tended to lag. And a lot of that was because of, one, a stronger dollar, and two, in countries outside the U.S., the growth picture is less clear, less murky, and more murky, and less strong. So those capital markets didn't perform as well as they have here in the home country. And then finally, that last mile of inflation that we've talked about, right? We're well off the peaks, but getting to the Fed's long-term target of 2 has proved very difficult. And in fact, more recently, it started to go in the opposite direction. So at the end of 2024, for the full year, inflation rose 2.9. Roll forward into January this year, that was at 3. So it's kind of heading in the wrong direction. What that is doing is it's calling into question the Fed's path from here, right? When are they going to be able to cut rates again? By what magnitude? And so forth. So that's all kind of being debated by market participants in their pricing. And the reason that that's important is that really just going to manifest in more volatility in our view, particularly in bonds, but they'll also bleed through into equities as well. So we saw a bit of that in the fourth quarter. It's really continued into the start of this new year. So that's kind of the broad strokes of what's been driving the markets. It's important because it'll inform how the options in the MDC have performed. Any questions before we look at the plan itself? Okay, so the intervening pages are a lot of detail on what we just covered at a high level. So if you will jump to page 19, we'll take a quick look at the asset allocation of the MDC. And there's a lot of detail on this page, but it's helpful. It gives you a bird's eye view of how the plan is structured, the investment offerings available to participants. So you can see at the top 2/3 of the page are the core options, active and passively managed. At the bottom is the target date funds managed by Vanguard. Those are passively implemented. So this hasn't changed in part because it's a very sound design. It offers all of the main asset classes that a participant could want, similar to what you do in the DB, although they direct their allocations individually. There are really two ways the plan can grow over time, either the investment return column or the net new investment column. That's the cash coming in and out. So this just tells us a couple of the trends over the recent period. Investment return, as I mentioned, a lot of red there. Really few places to hide outside of cash and a few pieces of the equity market, large cap and growth. Those are positive contributors. Everything else was negative. And as is typical quarter to quarter, money tends to flow out of this plan as a mature plan, right? So you're seeing that 38.5 billion coming out. So all told, with the investment return and the money flowing out, the MDC stayed fairly stable in terms of its market value over the quarter. Now on the next page, we'll take a look at performance. And again, page 20 is a busy page, a lot of information here, but we think it's a great story if we have a second to dig in. And so I really want to focus your attention on that last 5-year column. Okay, we think that's a sufficiently long enough period to really evaluate manager performance. Quarter to quarter, a lot of that's noise. So if we go down that last 5-year column, a couple of things will hopefully become clear as you look at the data. One is that the top number for each of the investment options is often in excess of the second number. That's its benchmark. So that's the primary objective. That's what we want to see. Now the returns vary drastically strategy to strategy. That's because they're targeting different segments of the market. But importantly, within their own segment, are they doing well? Are they beating their benchmark? And in most cases, over this 5-year period, that is in fact true. So primary objective number one being met fairly consistently across the options. Then we move to the small numbers to the right, and those are percentile rankings in a peer group of similar strategies. And so that's kind of the opportunity cost question. If you weren't offering this strategy to participants, what could you be offering, and how do you rank within that distribution? In most cases, or in a lot of cases, it's above median, right? And that's what we want to see, right? Doing better than the median. So with that kind of high-level view over a long period, all of the options brought to bear for participants in the MDC are doing quite well, are meeting their objectives. And it's important to really remember that 5-year window. So that starts January 1, 2020, right? We had the COVID crisis. We had rising inflation, falling inflation, rising rates, falling rates, good markets, bad markets. So this is a really nice kind of microcosm to see how managers have weathered over time. The last thing we want to draw your attention to is two managers that we're monitoring a little more closely because they have qualified for the watch list historically, being Wellington Small Cap within the domestic equity section and Loomis Sales Large Cap Growth. You'll see an update on these managers a little later on in the DC committee meeting before we wrap up. But that's just another way that your staff is making sure that the managers are meeting their objectives. If they're falling short, we develop a plan on how to handle that. Importantly, one of these managers has qualified to move off the watch list. Its returns and performance has stabilized. And then the other is improving, but we're going to give them a little more time. Remember, there are two reasons a manager could find themselves on watch having fallen short of objectives. One is purely quantitative. We're reviewing returns quarter to quarter. There's also a qualitative aspect. So if there's personnel turnover, if there's other kind of activity at the firm or team level, that's something we're also keeping track of. Now jump ahead to page 22, if you would. And, as fiduciaries, as a committee with oversight of the staff and the plan, this is a very important page. We can't control the market environment, obviously, but one thing you can exert a good degree of control over is the cost of the investment options offered in the plan. And, nothing's changed here. If you remember, we review this often. It's a really solid report card. And the best way to read this is if you look at the second column from the right, that's the median cost of these investment funds, depending on their strategy, right? So that's kind of call it the average of the marketplace. One column to the left of that is the cost of the plans offered in the MDC. And if you go down across all of these asset classes and strategies, you'll see that it's often lower and materially lower. And how we're going to quantify that is go to the total row at the bottom. So the weighted average, the dollar weighted average of the MDC is 26 basis points, 0.26%. That's an expense ratio. That compares to an average of the marketplace at 84. So you can already tell that there's substantial cost savings. To put that in dollars, that's about $14 million in fees that would have otherwise gone out but remain in participant accounts and compound over time. And to just kind of hammer that point home, let's call that a 50 basis point difference. 26 to 84. Just to show how powerful compounding is, that 50 basis points doesn't seem like a lot, right? But over 20 years, if you can earn that, you will have 10% more in your account than you otherwise would, all else equal. So it's very important that, you control what you can control because it accrues meaningful benefits to the participants over the long run. So we always do like to end here because this is a strong report card and reflects great oversight and fiduciary duty of the investment committee. So that's all we have for the MDC. Any questions before we take a look at the ORP? Okay, so if you flip open the ORP book, this one we have to jump around a little bit more because of the nature of the three plans, but we'll just tend to highlight, some of the key differences. They really tend to inform, how participants have performed, right? So if you'll go to page 4, I'm sorry, this is page 2 of the book. You can see how the three providers have been allocated to, right? So the total ORP is about $2.14 billion at the end of the year. That's split across Corebridge, Voya, and TIA, with TIA really being kind of the behemoth in the space. 50% of the assets, over $1 billion in participant dollars. So now we're going to jump ahead and take our first look at Corebridge on page 10. And you'll see it's similar in nature to the MDC. Participants have allocated a little bit differently, but there are 15 options, a mix of active and passive, target date funds, and the like. If you go to the bottom of the page, you'll notice kind of similar to MDC with the change in the markets and flows, the Corebridge platform stayed relatively flat over the period, as we would have expected given the market environment. And then the next two pages, 11 and 12, look at performance. I'll just go to 12 real quick. And again, if you go down the last 3 and 5 years, things are performing as we would have expected, right? So that's something we want to see. Nothing's inherently broken. Nothing is, not behaving as we would expect given the market environment. So you go down the page and those funds that are geared towards equity, geared towards growth, have delivered the highest returns, whereas international equity, fixed income has suffered on a relative basis. Now we'll take a look at Voya real quick. I'll jump ahead to page 21 if you would. A slight difference with the Voya platform is in the target maturity at the middle of the page. So a component of active management here, whereas for the prior two, it was purely passive, purely index fund. Also, along the glide path, remember these de-risk over time, tends to be heavier equity relative to the market. On its own, that's neither good nor bad. However, it will translate into good performance for participants when markets have been rallying like they have. Right, when we had two phenomenal S&P 500 years, those in these target date funds will reap those benefits from the higher equity allocation. On the flip side, if there is a sell-off, if there is a correction, that could prove to be a tailwind. And then lastly, we'll wrap up on TIA. And so I'll have you jump to page 27. And this platform is similarly set up as the others. But the one distinguishing feature that we do like to call out often is the real estate at the bottom of the page. This is much more akin to what is offered in the DB plan. So this is core direct real estate, kind of a unique offering in terms of defined contribution plans. Something we think will add value going forward, particularly over the lifetime of a participant. Certainly hasn't been without its challenges though over the last couple of years, as we've talked about with real estate broadly, primarily in the office sector. So, this is an offering that we think has gone through a tough period, but hopefully coming out of that and could really benefit participants who choose to allocate there within the TIA platform going forward. So those are kind of some of the high level differences between the three plans. Tend to mirror the MDC, really following best practices and not dissimilar from what you're doing within the DB. All told, we think it's been a very challenging period over the last 5 years, and the last year, a lot of volatility. But hopefully, as you've seen, the investment options have behaved as well as expected, and the growth of the plan has really continued its trajectory as it has throughout history. So that's all we have today. We'll answer any questions that the committee may have.
Yeah, sorry, you go ahead. Yes, in terms of our investment strategy with the new administration that's in place now, president and everything, are you seeing any trends with our managers moving out of international markets, emerging markets due to tariffs, and maybe moving more into domestic, with the administration being America first, America building, things of that nature? I'm just curious if that's kind of, we got 4 years of this, and just kind of curious where the managers are thinking the best place to put our money is.
Yeah. First comment on that is, obviously it depends on their mandate, right? So it would really only be your global managers that can choose to invest between the U.S. or non-U.S. market. I don't think we've seen wholesale shifts in strategy based off the recent election, but certainly something that I think they're taking into account in terms of, risk calculus. Yeah, so I don't know if you have anything to add. I think I want to give you a more solid answer, but the truth is we haven't seen a lot of activity in terms of moving capital out of markets.
And second question, I didn't hear you talk much about private equity. Has it started to, they've held so much money at this point, like KKR, Goldman and everything. Has private equity started to release that money with the interest rates have gone down? Of course, they haven't gone to 2, which I don't know whoever thought that was going to happen, but they're at 5, whatever they are. And so has private equity released any of its money to start funding IPOs and various sundry other projects?
Yeah. We'll cover private equity in greater detail on the DB side, only because it's not investable within the defined contribution plans. But just to kind of tee up what we're expecting to see, we are seeing hopefully a bottom and turning of the environment. So the expectation is the IPO market will start to reopen, which has been closed since 2021. So capital has been tied up, held up, it's impacted fundraising and calling of capital. We're seeing signs that that is starting to go the other way, so positive development. If you break up private equity into the different market segments, a lot of them are actually starting to generate positive marks quarter over quarter. It's really venture that is still weighing down the overall private equity space, and that's back to 2021 when everyone got way over their skis. So hopefully we can flesh this out more in the DB, but I think just from a high level, there are a lot of signs that the market is going to start to do better.
And if I could just weigh in on the global managers, what we've seen in when we discuss it with the global managers, tends to be overweight to US and certainly the run-up in the US equity markets at the expense of non-US markets. We've seen, what used to be a 63-37 mix of US, non-US. Now you're at like 70%, 69% US, just because of the run-up in the markets, coupled with the fact that the active managers, some of the commentary I've heard is that some of their biggest overweights to US are taking place right now because they are looking at what is the growth story. And when they look abroad, they're not seeing the same levels of growth opportunities that you are in the US. So again, you can talk geopolitical concerns, you can talk tariff concerns, but the one thing that they said about the US equity markets, it's open for business and there's growth opportunities taking place more so than what they're seeing abroad.
Yeah, I mean, our investments, like you said, are shining star in all this and don't want to be called flat-footed as things move on because obviously, current administration changes, daily, hourly.
I want to piggyback the good treasurer's question. Do you not see any bearing of the volatile national political and financial situation that's going on now? Do you see that any bearing on entities like large public pensions like ours? Are we should be bothered or concerned about what's going on nationally?
So on the pension front, what you typically see is if you compare it to, let's say, the world index, right? A collection of all the securities, cap weighted benchmark. You tend to see the US pension funds are overweighted. They've got a home country bias in terms of their allocation to US versus non-US compared to the overall index, if you would. In terms of concerns and reactionary on the pension plans, tend to be strategic in orientation. They also delegate that investment selection to, there's a strategic component that comes from the trustees. How much they do the asset liability study, how much are we putting in the US, non-US, et cetera, and then delegate that authority to pick and choose the stocks within those strategies or fixed income that are going to generate the most return. They're not making that selection. They are not going at the tactical level, at the security level to determine, hey, XYZ manager, I'd like you to invest more in US and non-US. That's been allocated to the managers to make that determination. So depending on what their strategy is, if they're an international equity manager, they're going to hold international equities. But Alex's point, you have global managers that provide that allocation, the swing, if you will, because they invest both in the US and non-US equities, and they can make that determination where do they think the greater opportunity is. And that's where you see some migration to the US. In terms of what sustainability of the markets, what's going to be good? A headwind certainly is what's going to happen with interest rates? What's going to be happening with inflation? Tariffs in the short term, is it largely a bargaining strategy, or is it going to be actually implemented? And if it does, what is the inflationary impact? Is it short term or is it long term? And I guess one of the things people are saying, like, it may be good for the long term, but in the short term, maybe inflationary. That's if it's actually implemented. When we've seen, it is also a bargaining strategy to level some of the inconsistencies in the marketplace behavior that has taken place. So I know that's a long-winded question, but I think
Was.
from a trustee perspective, you're not seeing trustees make a strategic shift in allocation based on the current administration.
Any other ORP or deferred comp related questions while we're still in this committee?
Any more? What kind of question?
ORP or deferred comp? I know we're going to talk a lot more on the PERS side in the investment committee, but
Well,
while we're on this,
I was wanting to know about, well, the ORP and the deferred comp are the two areas that we have that the individuals actually control their own investments. Now, with us going toward a tier 5 that's going to have 5% going that, are these going to be the only instruments, or will the legislature need to pass legislation to allow individuals to have more flexibility, and how will that flexibility impact what we currently have? So my question is, since this is where our people control their own investments, is this going to be the limit of it right now?
So to be determined, it'll depend on how the bill passes and what the board sets up. But the way it's currently envisioned, and I think the way it would reconcile, these thoughts would reconcile to the current version of the bill, is it would create the DC side of the hybrid, which is currently contemplated, would be a 401A, which is similar but not exactly like ORP. And then the board would, similar to what we've done for ORP or MDC, would create an investment lineup that the individual would choose and direct their investments from. That's the relatively short answer. So to be determined, but it would be similar to this.
My question is, under Mississippi law, since that money is commingled now, and if it's commingled, are we limited to this, what we currently have, and can't go outside of this sort of structure? That's what I'm asking. I mean, once it's commingled, it becomes part of the retirement system, and we have to follow the state law. So I want to know the flexibility that the individuals are going to have.
Sure. Well, I may, by virtue of my answer, ask for Mr. Vetterli or Caroline Johnson to comment, but, and of course, we'll work through the legalities as it goes, but I don't believe that it'll be commingled. I think the DC side will be, the individual side will be separate in their individual accounts. That'll be separate from the DB. So in the way I understand your question, it wouldn't be limited. It would be separate.
I think that, yeah, well, commingling is very easily done and hard to undo. I mean, if it comes into a bank account that we're controlling and it comes here and we're going to write the yes.
Well, and let me say this too.
Our legal people are going to have to answer that. But my real question is, are the individuals in the defined contribution going to have any additional opportunities for investment other than what's currently in our ORP and deferred comp?
Well, keep it in mind, well, one quick thing, going back to the bank account comment, the way information, we'll use ORP as an example now. The ORP contributions don't come to PERS. They go directly from the institutions to the vendors. So that, just to keep that in mind as far as the commingling. To the other part of your question, and I may have lost my train of thought on that, so I apologize on that, but.
You can come back to it at any time.
But I don't think it'll be limited. I think it'll depend on, in this hypothetical scenario, how it is set up. In other words, if once the board does its action and creates the investment lineup, then for conversation's sake, those participants would be limited to whatever's in that investment lineup. But it'll be, we would envision it being similar to either ORP or MDC.
And are we limited by law then, what the board can set up?
Yes and no. Again, it'll depend on what the final law is that's passed, but the language so far is pretty broad in that it authorizes the board to set it up similar to the way these are. And I can't see because of the podium, but Devetta, is that everything? Okay, yeah.
Is deferred comp that way?
So deferred comp has some broad
Legally,
language.
right.
And then it says anything that's authorized in PERS is also authorized for us to allow in the deferred comp plan. This will be a whole new 401A separate plan, like ORP is separate from deferred comp. It will be the same way. This will be a separate, for these new to hybrid participants, it's totally new federal instrument, if you will, for these folks to invest their funds.
And it is segregated. It is their account.
It is their account, immediately vested, as drafted currently, they're immediately vested. It's all their money. They control it, and we would do target dates and also other options so that they could do an asset allocation of their choosing.
Dr.
Okay.
McCoy, the
I reserve my rest of my time for later for questions.
And on that, we were kind of anticipating it for tomorrow. And of course, Devette will be here, and then Ice Miller will be on the phone, you know,
Okay.
Jim.
I think where it gets even more complicated is, and this has been some discussion here, whether it happens or not, is, well, if the employer decides they want to give some more money in, well, would that mean if I work at a state agency, that's the 457 MDC plan? That's where the state has the authority to put more money in my account now because that doesn't exist currently, but it could. So if it did, is that where the spillover of the employer could put in more if the employee matches type of stuff? Well, yeah, there's a vehicle already there. If you're in it, or you could sign up with an account. That's where it starts getting kind of complicated. Now I got a 401A and I got a 457B. And so we're, but still not commingled, I don't think, still separate accounts because of the nature of them.
And as a school administrator, you're aware a lot of the public schools have a 403B and the universities as well. So there's all types of instruments that folks can use to save and to save more. It's really, we're going to be working hard to figure out what's in the final bill and design the plan accordingly for the hybrid. But as he said, there's opportunities to expand the 457. Cities and counties can already put in the employer match in the 457. State agencies, universities, K-12s, we cannot. So that's a discussion also. Everything is being discussed and working with Ice Miller to keep us within the framework of the federal law.
Can I buy stock in the computer programmers that are gonna have to do this?
You can if you know who they are. You have to guess.
Back, any other,
One quick question on ORP. Is Corbridge makeup, are they an older group? I'm just looking at they've got 35% of theirs in stable value. And where none of the other two are.
Corbridge was Dalek at one time.
And if you remember, they had the fixed products.
Okay.
And those folks who were
stayed with it.
previously
That's
in
right.
the fixed products, they're going now into the stable value products. So that's part of why you see such a large number there. I think those fixed products during this period of time, as he explained, it's been lots of volatility, were a safe bet for some folks. And some of them are terminated. We can get you the more detailed.
I was just curious because it's just the makeup of the distribution of the assets is so much different.
They're all three very different. Some of it is based on which target dates are offered. Some of it is based on pricing, fees, the company's strategy. Like, for instance, Voya, most people have an asset allocation. They're not in target date. Whereas we see in the other two plans, more folks are going toward the target date plans.
Tia's got 25% in target date.
Right.
any other DC questions? Okay, now, watch list.
Thank you, Mr. Chairman. Onto the watch list. There are two managers that are currently on NBC, on the watch list for MDC. It's Loomis Sales and Wellington Small Cap. Loomis Sales, they have been improving, but we've opted to kind of give them a little more time to prove that things are indeed improving there. With Wellington Small Cap, this is the same strategy that we employ in our defined benefit plan. We removed them from the watch list last meeting. The only reason we didn't remove them at the same time from this is we had a little bit of delay in data. So we wanted to make sure that this is a mutual fund product and ours is a separate account. We just wanted to make sure that the numbers were in line as far as performance goes. The initial reason for adding these portfolios to the watch list is there was some major change in turnover and key personnel at Wellington managing this account. Performance has done well, and the concerns with, new management being able to continue with performance has, has been, has not popped up. So we are requesting for the Wellington small cap portfolio to be removed from our watch list at this time.
So moved.
Is there a second?
Second.
All those in favor say aye. Any opposed? Carries. Okay. Plan documents for the ORP.
Sure. Thank you, Mr. Chairman. For this, we would like to ask for your initial approval to a slight change in the ORP plan document. This is simply to reflect the upcoming increase in the employer contribution rate. As you may recall, under current law, the ORP contribution rates are tied to the PERS rates, and the PERS rate is scheduled to go up from 17.9 to 18.4 in July. And this just simply reflects that change in the ORP plan document and the trickle-down effect from that change in accordance with current law. If approved, this will be initial approval, as we typically do with this type of document. And with that, we'd be happy to answer any questions, but otherwise, we'd like to ask for your approval.
Is there a motion for initial approval?
So moved.
Is there a second?
Second.
All those in favor say aye.
Aye.
Any opposed? And the motion carries.
Thank you.
Any other miscellaneous updates?
No other items from me, sir.
Then the defined contribution committee is adjourned.
Chairman, is it okay for me to call the investment committee to order? It is, absolutely. The investment committee is now called to order. And I think that our first item would be the capital market assumptions overview. So
Before we,
gather your group
Yes.
or go ahead with the
before we get started, I'd like to just kind of give an update of where we've been since December. For the month of January, U.S. equities were up 2.8%. Value stocks outperformed. Growth and AI-related stocks kind of faltered on news of DeepSeek's AI model that looked like it was going to be able to provide results at lower cost than its peers. Small cap equities, U.S. equities returned 2.6%. Global equities increased 3.3%. International developed markets returned 5.3%. And emerging markets were up 1.8%. So even with, a lot of the turmoil in macro events concerning possible tariffs, et cetera, there's still good investments all across the globe, and that's why we have a strategic allocation, and we don't let, short-term, volatility based on non-investment issues blow us from one direction to another. We try to stay course. We have managers that are real good at, finding those companies that are going to perform well, regardless of what political market or environment you may be in. So that needs to be taken into consideration. So anyway, PERS total portfolio for the month of January produced a very robust 2.57% return. And then so far for February, nearly last week, the S&P 500 sold off about 2%, nearly eliminating all of its gains so far for this month. But even with that, so far for the year, the S&P 500 is still up about 2.5%. And considering that PERS has a very well-diversified portfolio, that we have access to, we have allocation to assets all across different markets, and we don't have all of our money in a very concentrated S&P 500. PERS portfolio, total portfolio so far as of close yesterday has a estimated fiscal year-to-date return of about 6.6%. So doing very well, even with volatility in AI-dominated indexes. So, and with that, I'd like to hand it over. We have Adam Lozinski here to give us a review of Callan's capital market projections.
Okay, should I go from there?
Yes, sir.
Morning, good to see you all. So I'm going to start in the book that's 2025 Capital Market Projections and the Performance Review, tab 1 and page 4. So it wasn't all that long ago, I was just here talking with you all about our 2024 projections. Now we're talking about our 2025 projections. So we update this annually. Your strategic policy for your plan is going to be really the key driver of your long-term results. And so we update this annually, even though we anchor to long-term, it's a 10-year forecast. So we're trying to anchor to long-term expectations, but we do need to reflect what's going on in current markets. So we update this once a year, even though it's a 10-year forecast. So some of our core tenets that we think about that are listed here on the page, we're looking at long-term equilibriums, long-term relationships. Risk premiums are important. So of course we're expecting, you're going to get a higher return for equities than you do for bonds. Otherwise, why take the extra risk? Those are kind of the kind of things we think about. We're modeling betas here. So just think of that as passive exposure to the market. So any active management excess returns that you're getting from the managers finding better opportunities than the benchmarks is not going to be reflected in these numbers. And then lastly, I would say, we use a specific model for each asset class, kind of specific to that asset class. And then we look at the macro environment to make sure everything aligns in terms of what's going on with GDP growth, what's going on with inflation, all those sorts of things. So just wanted to give you a sense of how we think about this before we get into the numbers. On page 5, so what we're going to do is start out by just looking at kind of the key takeaways and the impact to your plan. And then I'll get into, with whatever time is left, I'll get into the thought process and the reasoning behind our assumption changes. But on page 5, here's some of the key changes for different asset classes that for our assumption set from last year to this year. So you see here, cash was held constant at 3%. So we're still expecting about 3% on cash. Core fixed income was reduced by 0.5% to 475. You can see public equities declined about 0.2 to 0.3%. We held inflation flat at 2.5. So we expect that it'll take some time, as Alex said, to get the rest of inflation back to the Fed's target of 2. So you start with something closer to 3 today, and over time work your way towards 2, and on average you get 2.5. And then in terms of private markets, generally following the public markets. So private equity, private credit both fell a little bit along with what happened to public equity and public fixed income. Real estate, however, was the only asset class that we actually increased the return expectation. I'll talk about that later, but that increased by 0.25%. And just based on the fact that that market has struggled a lot and is finally starting to turn around. On page 6, we have a more detailed list of our capital market expectations for 2025. So again, these are the 10-year returns expected. You can see we're on page 6 here, you can see the 10-year geometric, that's the compound return that we expect for each of these asset classes. And then the other highlighted column, standard deviation, that's the uncertainty associated with those expectations. And then we have highlighted the asset classes that are used in your plan in orange here. And so just a couple things I want to point out here that were not already listed in the summary on the prior slide. We have a couple of custom asset classes for you. Global equity is one here that's in this at the bottom of this equities section at the top. What we do is we take the cap weighted large cap US, mid cap US, developed ex-US, and emerging markets. We just take the cap weights and apply that to those different components, and that's how you get to that global equity expectation. The reason I want to point this out is you'll see that it's 7.6, whereas the other ones are, 725 to 745. It's not that we're saying we think global equities are going to do better, but the way that we build that assumption using the underlying components, you're seeing the diversification benefit come through. So by using those other pieces, that diversification benefit comes through, and that's why the return is a little higher. So not necessarily a call that global equity is going to do any better than the other pieces. We also have custom fixed income here, and that just looks at more of your actual structure within fixed income. So some core, some high yield, and some short duration. And then a couple other things I would point out, just again, a reminder that for the public markets, so the equities and fixed income pieces, we assume passive implementation. So any active management is not going to be reflected here. That would be a way that you could improve on these numbers. And then all of the assumptions are assumed to be net of fees.
Can you explain for me or remind me on the projected risk, the standard deviation, is that charted on the bell curve, or is that start at 0 and go to 100? What does that number there reflect?
It's charted on the bell curve. So if you think about in the middle of that curve would be this 10-year geometric return. And then the standard deviation is how much uncertainty we have around that number. So we think.
Would that be like 17% below or 8.5% below and 8.5 above? Like that first number, 17.35. Is that 17 on both sides? So it means about a 30,
Yes.
somewhere in that range between the 17 on the negative and 17 on the other side. Is that what that means?
That's exactly right.
Okay.
Yeah. So you could think of it as 735 plus or minus 1735 would be a one standard deviation move.
Okay. Well, that's so because you use that kind of number throughout your presentation, I think so. Just make sure I'm not a standard deviation or two off in my thinking. Okay?
Sure.
So.
Yeah, I think when we translate it to, a range of outcomes, which I'll do here in a couple pages, it makes a little more sense. But yeah, it's trying to represent the uncertainty around that. And so, as Alex was kind of saying to me over here, that 2/3 of the expected outcomes are going to be within plus and minus one standard deviation. So that just gives you a sense of what can happen in any given year. But I'll show you here shortly that once you compound over time, things start to narrow in towards that 10-year expectation.
It's about 34% on the left, 34% on the right. So this is kind of halfway in between on
Yeah,
that part.
that's right.
Right.
That's right. And then more
off
extreme
the
events
median.
are
Okay.
outside of that.
That's good for me. Thank you.
Okay. So, okay, page 7, I think is just some useful context for your 7% expected return that's used in your plan. So what we've done here is that we just use the Callan capital market expectations that were in place at different points in time, and then come up with, a reasonably diversified but as simple as possible portfolio to get a 7% return. And what this shows you on the left-hand side is back in the middle of 1995, based on where interest rates were, which were much higher, you could actually get a 7% return with all fixed income and cash. And then as you move towards the right, you see that in order to get a 7% return, portfolios had to get more and more risky because interest rates were falling, so that, that safest asset you have, fixed income, was getting less returns, so you had to look elsewhere to get higher returns. And you can see that that bottomed in 2022 with a portfolio of only 4% fixed income. Now, this is, importantly, these are not portfolios we were recommending. It's just a hypothetical example of, what would you have to do to get a 7% return? So in 2022, for example, a lot of clients, yourselves included, were having to accept that the return expectation was lower than your target for a time. Thankfully, Alex mentioned that with interest rates rising, that's been challenging for fixed income performance. But thankfully, going forward, that means higher expected returns for fixed income, which means now, in 2025, you see that a portfolio with 37% fixed income could get a 7% return. So luckily, we're moving the other direction, but of course, you have to endure some pain along the way as rising interest rates tend to cause bond prices to fall. But this is just, I think, some helpful context for that 7% return target that you have, and how you've, you've gone through a period of probably are expecting less than that to now maybe a little bit more. So we're kind of right in that range. I think 7% remains a useful target number for you all.
And that risk is lower because, just because of that, there's less chance. If you're expecting 5% return on fixed income, let's just say, it's less likely to go to 2%. More likely they're going to be at 4 or 6, right around in that range because of that compressing, if you will, that standard deviation, or that's the result of it, is having less volatility because it's going to be closer to that, let's just say 5% on fixed income.
Yes, because fixed income, but outside of the last couple of years where we went from historically low rates to a massive move in higher in interest rates, typically fixed income is your best diversifier, lowers the overall portfolio risk, and then fixed income itself tends to have lower standard deviation. So that's how you get a less risky portfolio. But if you can get more return out of that fixed income piece, that just helps you deliver those returns with less overall total portfolio volatility.
You still could easily keep it, again, these are just hypotheticals, what you could have, but we're still more like the one to the left of this.
The 2022?
Yeah.
I think you have about 20%
Somewhere
in fixed
between.
income. So
So
it's
somewhere
kind
in
of somewhere in
between.
between.
Okay.
And I would say that relative to your peers, 20 to 25% for most public plans is actually pretty in line with most peers. I think a lot have gone, not moved this full increase in risk, but moved generally that direction, but you're not outside of your peers.
Okay. Thank you.
We'll see this later, but the median large public pension plan had a 19% target for fixed income
Ours is at 20.
versus 18.
18. Okay.
You're right in line.
Okay.
18 for public fixed income and then 2% for private credit. So overall,
Okay. All right. Thank you.
where I was getting the 20. Okay, so on page 8, when we take our capital market expectations and apply it to your policy target, that's where you get, on this table on the left, you see the projections with 2025 assumptions, the 10-year geometric return of 7.3. If you compare that to the prior year at 7.7, it is down a little bit. But I would say that in 2023, the expectation was 7.4. So you've kind of just done this round trip from 7.3 up to 7.7 back to, or 7.4 up to 7.7 back to 7.3. So kind of in that general range, just above your 7% target. So I think overall, it feels like you're in a good place with the strategic target, getting something close to that 7% expected return.
And that's a gross figure.
This is assumed to be net of fees, but it does
Okay.
not include any active management. So you could potentially outperform these numbers if active management does better than passive.
Okay.
Now, importantly, these numbers in the table are, again, that sort of median expectation in a range of potential outcomes. So here's where we quantify, what is the uncertainty or that standard deviation? What's the range that you could expect normally? So on the right-hand side, you can see that in any single year, when you account for that 7.3% return, but a 13.8% standard deviation or uncertainty, we would expect, almost all of the outcomes to be between -13 and +31. But that's any single year. So there's obviously much more volatility in a short time frame than there is in a long time frame. So over time, when you compound over 10 years and you start to get some offsetting single year numbers, you narrow in towards that 10-year and you see the range is much narrower around that 7.3 expectation. But we do need to reflect, there is uncertainty around these numbers. But the positive is the probability of greater than 7% you see on the right-hand side of this chart on the right, 53%. So you want to be right around 50, meaning that in the median expected case, you meet your target and you're just above that, which is a great place to be. Any other questions? We wanted to get to the key outcomes before we get into detail.
This also says that there is a 4% chance that we won't get any gains. Is that right?
Yeah, right. So you're looking at the probability greater than 0 is 96%.
96% we're gonna make something.
Yes.
And it's over 50% chance that we're gonna hit our goal of 7%. And so, okay.
Yeah.
That's good.
Yeah, and so the reason you don't see a negative number here is we show the 5th percentile to the 95th. So essentially, to get a negative return over 10 years is going to be a very extreme 2 to 3 standard deviation event. Rare, but it's possible.
Did we at some time have a 7.5%? And we drifted down to, now we're struggling to have 7?
We just moved our, anticipated rate of return to 7%. That's what we did, and now they're telling us right here that in the next 10 years, we should not expect to have a 50% chance that we're gonna make 70% over our 7%, so.
But did we at one time having a 7.5?
7.55.
You got a
Yes.
7.55, yeah.
Yeah.
Which you would not have met under these conditions as it's laid out.
And that's actually true of, again, looking at most public plans. So if you look at there's a group called NASRA that surveys all the different public plans and pulls that together. The average expected return has gone from 8 to 7.5 to 7. So you're right in line with the average right now. It's not just you that has lowered that expectation. A lot of that is due to that fixed income expectations coming down so much and people not wanting to take so much risk to try to pursue those 7.5s and 8s.
So over the next 10 years, we expect to make our 7%. If someone were to come and say, yeah, but if we get a negative 4%, that would be way outside your projections.
Over a 10-year horizon. So
Over a
again, if you look
10-year
at any
over a
single
10-year
year,
period.
if any single year, they would be well within expectations to have a small negative. But over a 10-year horizon, that would be very, very rare.
That's what I'm saying. Over a 10-year period, it would be extremely rare.
Yes.
For that to happen.
Yes.
Okay. One other question. Somebody asked me the other day, what percentage of our portfolio was in equities? Do we consider private equity in that when you lump all those together? Up in the left-hand side, there's 57% are in U.S., non-U.S., and global. Do we add that other 10% and say, yeah, we got 67% of our portfolio in equities?
Typically, yes.
Is that what we say?
Yes.
Okay.
Yeah.
Okay. Thank you.
Okay, so we started out with kind of the key takeaways, probably the things you're most interested in. Now, with whatever time we have left, I'll get into some of the support as to how we got there. So starting on page 10, again, I'm going to start with the macro because as I mentioned, we kind of think about the macro overlay and how that impacts all asset classes broadly. So we'll start there. And really, I think Alex kind of hit some of this. You know, the economy proved to be more resilient than a lot of us expected. You know, we went from a couple years ago expecting a pretty, reasonably large recession given COVID and inflation and interest rates moving up, all those things, to, okay, maybe the recession will be more moderate, to now kind of, is one going to happen at all? I would say that in all of our 10-year projections, we assume some recession will occur, but it's no longer as clear or certain that it's going to be a result of COVID disruption and inflation and interest rates. So we assume there's going to be some sort of recession, but it's a little bit more possible that the Fed achieves this, the fairy tale soft landing that everyone talks about, where you get inflation back down without causing a recession. I'll talk about that a little bit. So it's been a more resilient economy, which is a good thing. A lot of that is because both consumers and businesses came into this, rate hiking cycle and inflationary cycle with pretty strong balance sheets. A lot of that because of government stimulus coming out of COVID. So I think that consumers have been strong, jobs have been strong. That's led to, strong GDP growth while still being able to drive down inflation from its peaks. On the inflation front, Alex also kind of hit a little bit of this. We've gone from something, I think it peaked at 9% in the middle of 2022 to about 3%. I think the low-hanging fruit has kind of been picked. I think it's going to be a little bit harder to get back from here to the Fed's target of 2%. So we think that can take some time. I think that the tariffs that have been discussed are another thing that could cause a short-term inflation. So that's why we kind of kept our inflation expectation at 2.5, is we think it'll just take some time to get rid of the rest of that. Like I said, the low-hanging fruit has been picked.
So how many years do you leave it at 2.5 before we say, well, we're just not ever going to get to their target?
It's a good question. I think what we assume is over 10 years, we're at 3, and we assume that things fall towards 2 over that 10 years, and when you average that out, you get to 2.5. If it proved to be that the Fed actually increased their inflation target, just kind of saying we don't think we're going to get back to 2, then we might reconsider how we put that into our forecast. We're not there yet. We're still confident that they're going to do what it takes to get to 2. But if they were to move their bogey, then we would likely move ours. So on page 11, the Fed's dual mandate is strong employment and low inflation. So we'll kind of look at both of those pictures. On the labor side, generally the situation is one of cooling a little bit, but still pretty strong. So you can see unemployment in the top right has ticked up a little bit, but it's still around 4%, which is actually the Fed's long-term expectation. So that's kind of in line with equilibrium. You can see job openings in the bottom left have come down quite a bit, but still well above pre-COVID levels. So still employers signaling strong demand for employees. And then in the bottom right, when you look at job losses, whether it's initial unemployment claims or layoffs, you see that those are pretty low levels as well. So overall, the labor market remains strong. That has led to pretty good wage growth, which is another reason that inflation has stayed high. But if that's probably the best reason to have higher inflation is if wages have kept up and then consumption has kept up. On the inflation front, page 12, I mentioned, we came down from this peak in the middle of 2022 of 9% to something closer to 3%. A lot of the reason that we were able to get inflation down without a recession is that you had the supply chain recover after COVID, you had strong jobs, you had productivity increases. So a lot of that allowed inflation to come down without a recession. And that's why we think that it's just a little bit harder to get the rest of that out of the system. But it's been obviously some improvement, just more to go.
I've heard all my life a saying, and how about the price of eggs in China? Is that, that's what, but never mind. Apologize.
No, I don't have any insight on that.
Okay. All right.
Okay, lastly on the macro, page 13. The Fed, I think, is following what we think is a good philosophy of reacting to actual data as opposed to using their forecasts. But what that has led to is a decent amount of volatility in their forecasts, just as much as any of the rest of us. So what we show here in the bottom left chart, that dark blue line is what the Fed thought 2024 GDP growth was going to be. And then each dot is when they made that prediction. So way back in March of 2022, they thought that 2024 GDP growth would be 2%. Then as you had inflation and they had to raise interest rates to combat inflation, them along with us and everyone else thought that that was going to cause a recession. So you see that expectation for GDP growth falling. And then, of course, the economy proved more resilient than we all thought, and you see that the expectation just rise right back up. And why that's important is because in the top right chart, whether you look at the Fed's expectation of the appropriate interest rate for 2024, 2025, or 2026, they're all trending upwards. So short-term rates, it seems, are likely to be the higher for longer that you've likely all heard. Any questions about the macro environment before we get into some more detailed expectations on specific asset classes? Okay, so let me move to page 15 and we'll just talk about our fixed income expectations. We've showed this before. We use this building blocks approach to come up with our fixed income expectations. Consists of income, which is the primary component. Usually the yield that you get from holding bonds is the primary driver of returns, and that's why higher interest rates now is a good thing going forward, even though it was challenging to get there. Capital gains and losses would be the change in the bond price as interest rates change. We think that interest rates will be volatile, but more stable around a current level, which I'll show on the next slide. So we don't have as much happening in that capital gains loss column as we have historically. For example, when we went from extreme lows in 2021, 2022 to where we are today, that, of course, caused the fixed income returns to be negative. Credit defaults or downgrades is a small component. It's just a change in the bond price if the credit rating changes or the riskiness of the bond changes. Then roll return is just extra return you get when the yield curve is upward sloping, which, as Alex mentioned, we've returned to a more normalized yield curve. So if you take the aggregate or core fixed income as an example, kind of in the middle of the table here, you just look at the different components, you add them up, you get to a 4.75% expected return. You can see most of that is coming from income. So that's consistent with history, and that's why fixed income expectations are higher, is because that yield that you get on those bonds is the primary driver of what return you're going to get going forward. On page 16, this is what I was kind of talking about the interest rate volatility. So what we're showing here in the blue line is the yield on the Bloomberg aggregate. That's the core fixed income index. And then the straight line that goes through is the long-term median. And that's what informs for us, what informs the equilibrium or where we think things are going to end up. So when you look at the blown up, called out data on the right-hand side, you can see we went from those extreme lows in 2020 through 2022. And then we had a massive rise upward very quickly, which was painful to get there. But since then, there's just been kind of a lot of volatility around this trend, this equilibrium trend. And so that's where we're saying, we think there's going to be volatility in the market for sure, but we think we're closer to where we should be in the long run. And that means that you would get these higher yields with, the change in bond prices sort of washing out over time. Any thoughts about that before I move to equities? Okay, so on page 17, for equities, we also use a building blocks approach. Broadly, we break this out into income and capital appreciation. And then there's this valuation adjustment as an extra factor that we use sparingly, but we have used this year, and I'll talk about that. But if you look at the first line here, S&P 500, that's our US large cap equity expectation. You can see most of the return is expected to come from the capital appreciation. So that's real earnings growth, which is tied to GDP, plus inflation. And then you see the negative 0.25% valuation adjustment, just with equities being richly valued. I'll talk about that. We use that sparingly, but we've used it a couple times in the last few years, and I'll show a slide here shortly about why we did that. The next line down is non-US developed markets. You can see that the total expected return, 725, is the same as US large cap, but it gets there much differently. It's much more driven by dividends, a little bit less by capital appreciation, a little bit less by earnings growth. And I think that gets to, the challenges, say, in Europe with their economy not being quite as strong as ours. And then emerging markets is the last one we show here. We do maintain an expected premium for emerging markets over developed, whether you're talking about the US or non-US. And that's driven by largely by a higher expected real earnings growth, but also higher inflation, because these returns are in nominal terms, so they include the inflation, which is over time typically passed through to stock returns. So that's how you get a little bit of a premium for emerging markets. I think I'll skip 18 just in the interest of time and go to 19. So I was talking about this valuation adjustment that we use. So what we're showing here in the blue line is the price to earnings multiple on large cap US stocks over time. And then in the green straight line and dashed lines, it's the long-term average with plus or minus 1 standard deviation. Now we as a group tend to be much more hesitant to use a valuation adjustment than most other forecasters. So we only do it when things get extreme. And you can see on the top right-hand part of this chart that valuations were more than 1 standard deviation above the long-term average. And that's when we think that, over time, probably that will start to get priced in and be a headwind for stocks. And in the table in gray on this page, really no matter which measure you're looking at, so if you don't think price to earnings is the right multiple to look at, really whichever measure you're looking at, things were richly valued in the US. Large cap specific. So for small cap and then in the non-US, whether it's developed or emerging, valuations are more normally priced, so we didn't do the negative valuation adjustment outside of US large cap. On page 20, getting into core real estate, I mentioned this was the only asset class where we saw an increase in our expectation going from 6 to 625. So if you think about every other asset class falling, real estate increasing, that obviously makes real estate look a little bit more attractive this year than it has in prior years. And on page 21, we show a little bit of the detail there. So our team built a model that looks at real estate sector by sector. Particularly after COVID, you had a pretty big divergence where office, of course, was struggling. We all know that's but things like industrial, so e-commerce and those sorts of things were doing really well. But if you look at the chart on the top right of this, you can see those lines all going upward. So really what that means is that all of these sectors have had a repricing where they've taken a hit, cap rates have moved up, and that means that the expected return going forward is higher. So we just think that this marks a better entry point for investors. And our real assets team, I'm sure you all have met some of the members of the real assets team, is telling us that, if we're not at the bottom, we're close. In fact, the core real estate index has finally seen 1 or 2 quarters of positive returns after 7 straight quarters of negative returns. So we may not be at the bottom, but we think we're close. So that for the next 10 years, we just think that we've turned the corner in real estate. Whereas the other asset classes repriced a little more quickly, real estate is just finally getting there. For private equity on page 22, the story is kind of simple there. We tend to believe that there should be a consistent illiquidity premium where private equity follows public equity. So we just dropped that 0.25% in line with what we did with public equities. There can be a lot of dispersion in that asset class, so the range around that can be quite wide, but that's our sort of down the fairway expectation for private equity. Private credit, similarly, we kind of come up with a sort of down the fairway expectation for that. There's a wide range of ways that you can implement private credit. There's a wide range of outcomes with specific managers, but that assumption fell a little bit in line with what happened to public fixed income. And then one more thing I wanted to hit, if I could, on page 28 in the appendix. So we've been asked a lot by clients, how good are your expectations? And, we never expect our expectations to be perfect, but we just want to make sure that they're reasonable enough to make good asset allocation decisions with. And so what we've done is we looked at, the expected return for a simple but reasonably diversified portfolio of stocks, bonds, and real estate. We look at our expected return compared with what the market actually did 10 years later for that portfolio. And you can see, so our projections are in orange. The actual return 10 years later is in the blue or teal. And you can see that pretty consistently we're within 1 standard deviation of the actual outcome. And I think that to us is proof that you don't have to be perfect with these expectations, but if the relationships between asset classes are right, you end up with portfolios that are reasonable and you can make useful decisions with these numbers. So hopefully that gives you a little confidence in our expectations, even if they're not going to be perfect.
Any questions?
Any questions? Yes. We appreciate that, Adam.
All right, thank you.
Thank you. Charles?
Dr. McCoy, before we move on, I'd like to answer your question about the price of eggs in China.
Just wondered, my mother always said, how does that affect the price of eggs in China? And then wait,
Well-
the price of eggs, I'd like to know what they are in China.
There's a lot of things that, affect the price of food, regardless of, where you're at. The numbers I'm going to give you are in US dollars. So some of the numbers you see for, other countries, there's going to be exchange, effects in place. But the country with the highest price of eggs is Switzerland at $6.74 a dozen, updated as of yesterday. These are for regular eggs, not your fancy range-free gluten-free, whatever. The United States was the 13th highest in price of eggs, at nationwide average of just under $4 at $3.99. And then China brings us all the way down to, they are the 110th most expensive country with eggs at $1.62. So just to kind of let you know.
Well, apparently.
Now, what
the
that has
bird
to
flu
do with
has
what
not
we do,
impacted the price of eggs in China.
yeah, so, anyway.
They don't worry about what they're feeding you.
So, the next thing on the agenda is market update. You'll find that in the same book towards the back there that you're currently in. And Mr. Jackson with Callan will bring you through that publication.
Thank you, Charles. Let's turn to page 4 behind tab 2.
Is that the fourth quarter 2024 performance review?
It is.
Okay, good.
It is. We changed the format of this slide a little bit just to make it, there was a lot of text in there before. We thought this might be an easier read, but this is the one pager that kind of just covers the market value of the assets, allocation statement, as well as looking at the short and long-term performance. The fund assets stood at $33.9 billion as of the end of December, a decrease of approximately $1.4 billion from the end of the third quarter. And that negative investment return resulted in a reduction of about $424 million, while net outflows reduced assets by $1 billion. So you may recall fourth quarter is the time of the 13th check, has a big impact on the outflows. Asset allocation was in line with the strategic targets, underweight to real estate by about 1.3%, and that was largely offset by the overweight to private equity at 1.4%. Again, private equity, we have less control in terms of it's more rigid in terms of dollars coming in, going out. It's a less liquid investment, but we're going to be talking a little bit later today about the need to maintain that vintage year investments so that you may have bands surrounding your target allocation, but to keep in line and keep that full investment exposure. For the chart that we have here, reading from left to right, we have the asset classes in 3 bars. So the first bar is, let's call it, I apologize for all being blue, but navy blue, and then we have blue green, and then we have sky blue. And the first one is the quarterly return. We saw that domestic equities at 2.1% were positive. So that's, let's call that the S&P 500 return was close to that. Global equities were negative 0.3, international equities negative 7.4. Fixed income was negative for the quarter, real estate negative for the quarter, private equity was positive at 1.7, private credit at 2.7, and then cash at 0.4. So that we see that the total fund return was down 1.3%, which was roughly in line with the benchmark return for the quarter. But we see the second bar in there is the fiscal year to date return. And if you look to the far right for the total fund return, you see fiscal year to date. So that's July 1st through 12/31 was 3.8%. And then the 1 year total at 9.8%. So again, that was trailing the markets were very strong for the 1 year period, over 10%, but again, a strong 9.8% absolute return. Over the long term, we continue to see that the fund has outperformed its benchmark over the 5, 10, 15-year periods with annualized returns of 7.7%, 8%, and 8.9% respectively. So that's an annualized return, meaning if you took out the long-term average, those were the returns you would see on a per annum basis. Any questions about that? We're going to go to a little bit more detail on the returns in a moment. I'm not going to spend a whole lot of time to go through the capital market slides. I think between Alex and Adam, they've covered in large part, but I would say on slide 5, we talk about the idea of why the 10-year projected returns are healthier than they have been in the past is the contribution of fixed income. So if you look at the US Treasury yield curves below on the bottom left quadrant, you'll see the 10-year return as of 2021 was 1.5%. So that was the yield on the 10-year return. And now we see that the curve has normalized somewhat as you look at the orange line. The yield on the 10-year return as of year end was 4.58% return. So again, the idea there is that you're getting more money in yield from a fixed income investment if you invested today versus what you did in 2021. Now, the path to get there, again, for those pre-existing investments, took a price hit to get there, but certainly looking forward, we see a more favorable yield component on fixed income. On slide 6, this is the Fed's dot plot chart, which gives an indication of how they see the Fed fund overnight rate. And again, the takeaway here is that we saw in 2024 3 consecutive cuts to the tune of 1% at the last 3 meetings in 2024. No movement in the January meeting, and the expectation for rate cuts for this year went from about 4 cuts in September of last year to now 2 cuts are expected. So 1 or 2 cuts at 25 basis points. And again, based on what the market is saying, the likelihood of 1 cut by year end is about 34%. And the thought about 2 cuts being about a 31% probability. So again, the idea here is that rates are probably going to be a little bit higher for longer, particularly in light of the uncertainty of what inflationary actions might be taking place. Turning to the next slide, this is the comprehensive slide. We see that the box that's in orange captures the 1-year returns. And the big news here is, again, the S&P 500 was up 25%, coming off a year where it was up 26% the year before. Non-US equities we see for the quarter, as measured by the MSCI World ex-US, was a negative 7.43% in the quarter, and that's due largely to the strengthening of the dollar. So the strong dollar is a headwind to returns when you have a foreign investment and you're bringing those gains back into the US. If you have a strong dollar, it is detracting from the return, and the dollar was up about 7%. So accounted for a large component of that negative return for non-US. We talked about the Bloomberg aggregate. This is your broad benchmark, negative for the quarter, up 1.25% for the year. Real estate, again, showing 2 positive quarters in terms of return on the income front. So we see that over the 1-year period, private real estate was up about 0.4%. Private equity, the Cambridge Private Equity Index, this is the value or the return as of 9/30. Again, this is based on private equity returns come in, and there's a lag in terms of when that information is reported. So 1-year return at about 7.9%. Inflation at 2.89, and that covers the gamut. On slide 8, we talked about the histogram. You know, what do the recent returns look like? And you see that a host of the returns, with the exception of 2022, where the S&P 500 was down 18%. You look at the 2020 return up 18.4, 23, 26%, 24, 25%, 2021, 28%, 2017 at 21.8. The long-term average on the S&P 500 is about a little over 10%. So what we've seen is some really strong equity markets in the US as measured by the S&P 500. And most recently, it's due to this concentration effect of the Magnificent Seven. I'm going to skip over some of these returns and get to real estate on page 16. And what we see here is the Encreve Odyssey. Again, this is a collection of open-end funds, which makes up a large portion of the Mississippi PERS investments. We see the last quarter, the Odyssey was up 1%, and that was due to an income component of 0.8 and appreciation of 0.1. Over the last year, that was down 2.3%. And again, while income was positive, the appreciation or the depreciation was 5.4% in a reduction in valuation. So we see that over time, this appreciation component, certainly for the last 5 years, has been a drag on the performance while it was still generating positive income returns. Below, we see the quarterly, and we have the two components, income and appreciation, and you can see that hotel and office were the two areas of the market that were hardest hit. Again, the other portions of the market we think are more resilient, they'll bounce back, but certainly the office component of the market continues to present challenges. So that covers that. Turning to private equity on page 18. Here are some of the different strategies, and you can see here, while generating a positive return, venture capital over the last 3 years, negative 5.3%, growth equity at negative 0.5%, but we see that certainly buyouts at 6.3% and credit opportunities at 7.6%. Those are more positive areas. So what's it going to take for private equity to experience some of the success that they've had historically? And again, that IPO market, right? Bringing these private companies to market and really realizing their return. And certainly a strong component of that in terms of timing to bring to market is lower interest rates. So while we're in we've seen some rebound, the idea that rates may stay higher for longer is a little bit of a stall, but we continue to feel like most of the pain in the private equity markets have been experienced already. So,
Tom,
yeah.
how now, since they've had the IPO stay, how do they get the money out of the business now, or do they, as far as that goes? I mean, do they sell it? I mean, how does that happen? If it happens.
So if you have a company that has realized its value, you're looking for, again, who's going to buy it and how are they going to finance it? So a lower rate environment makes it a little more attractive to be able to take that money and put it to work. And their cost of capital being lower, those private equity companies look a little more attractive, if you will. So the idea of the rates coming down certainly was a tailwind for the private equity exposures. We're in a period where there's so much uncertainty. A little bit of clarity was certainly happened, like when we talk about these tariffs, for instance, and the headlines. What is really the long-term intention, or what is due to bargaining and realizing the benefits of that? So the idea, there is a lot of cash sitting on the sidelines. A lot of these funds are sizable, and these investments are being realized. But again, the strength of the market makes them a more attractive target, if you will, for capital.
But the IPO gives them another avenue for getting money out of the business, basically. This may be less interest rate problematic, at least.
Correct. Yeah, the idea here is lower interest rate creates a more favorable IPO environment. And that's where things like particularly venture capital are being realized in that type of environment.
Thank you.
Yep. Any questions on that before we turn to the fund performance? On page 20, This shows, again, the overall value at 33.8 billion as of 12/31. Shows the actual weight and the target weight, and suffice to say that they're all the target allocations are within reach. Private equity at 1.4% is about 1.4% over the 10% target, and the real estate is 1.3% under. Both of these are illiquid asset classes. So in other words, the write-downs in real estate account for the, being short of the 10% target, and certainly the run-up in private equity over time at 1.4% explains that overweight. Again, we tend to think when we look at how the fund is allocated, compare their targets, plus or minus 4% is a pretty common metric. So again, when something is 1.4%, we think that that's certainly well aligned with the target allocation. On page 21 is a slide that Alex made reference to. I'm just going to touch on it. What this shows is looking at the universe of funds at over 10 billion and those that have exposure in these asset classes, what is their average allocation or median allocation? And we see that, again, your domestic equity at about 27% target for domestic equity is right in line. The median is 26.3. So you're in line with your peers. Your fund target at 20% to fixed income versus the median is 18.9. So again, the idea here is that your broad allocation is in line. I guess the one area where you might be a little heavier than peers, if we look at international equity at a 20% allocation to many of your peers at 14.3. So that's the overweight, but overall, the allocation of the portfolio may be a little bit heavier on the equities, public equity side than your peers, but not significantly. When we look at the cash movements on slide 22, this breaks it out by the asset categories, and we see that, again, the way to read this is moving from right to left. So we have a beginning balance of 35.3 billion. The investment return, with the exception of private equity and private credit and cash and domestic equity, which were black in positive returns, we see the others had struggled during this particular quarter. And we see that the investment return overall was about a $424 million drawdown. Net new investments, this is your cash flow, cash coming in and out. We can see that money has really been taken from most of the asset classes, and we see that the money going out of the fund was a little over $1 billion to give you the ending value at 33.9 billion. Any questions? One thing I would say is, again, you see that the private equity number, a drawdown of 40.5 million. So that's an example of the earlier vintages that you have are throwing off cash distributions. You're getting that cash and we're taking it out of that particular asset class. So that helps explain the need. We describe it as a pacing study, but we continue to reinvest or reallocate to private equity so that you have, think, dollar averaging in over time to maintain your exposure to that asset class. Page 23, this provides the performance of the fund as well as its peer comparisons. And we see that over the last quarter, overall the fund was down 1.25%, which was in line with the policy benchmark. Over the fiscal year to date, 3.75%, trailing the policy benchmark of 4%. But if you look up to the peer ranking, you see that it's in the 47th percentile. Smaller numbers are better for these particular charts. So again, that's outperforming 53% of the peers. Over the last year, a very strong 9.75% return, albeit trailing the benchmark of 10.4. But we see that if you look at the blue dot and you see that's in the 37th percentile, that's outperforming 73% of the fund, or I'm sorry, 63% of the funds out there. 3 years, again, we've had a negative year in there that really penalized the fund, but we see that again at 222 versus the policy benchmark at 250 in line. And as we look at the 5, 7, 10, and 15 years, we see that in all those cases, we have performance of the fund outperforming its benchmark. And importantly, when you look at your peer comparison, those blue numbers, you see in the 5-year period right at median, in the 7-year 40th percentile, 10-year and 15-year 24th percentile and 17th percentile respectively. So again, performance has been very strong in the long term. And I guess what I would highlight when we turn to the next page, we can see that not only has performance been strong in the long term, but in the calendar year, we see that 2022 was a particularly painful year. The policy benchmark was down almost 15%. The fund was down 13.6. So again, not, while you never like to see a red number, the idea here is that to perform better than the policy benchmark in down periods certainly is helpful. And we see the same was the case for 2018 at negative 3.7 versus negative 5.22 for the benchmark. So again, strong performance, both near term and long term, and most importantly, the longer term performance exceeding that 7% assumed rate of return that is so important for the long-term viability of the program. So I'll take a stop there, answer any questions that you might have.
Questions? Yes.
So is it just a coincidence? I know this can change year to year, depending on the strategy, allocation, all that. But it seems like that 2022 year where it was down, we're obviously down more than you would want to be. But
Yep.
is that also the reason why the benchmark and PERS fund is closer to the top typically on the other years when there are gains? I mean, is that because of the way the allocation is done, and so that when we're not as well positioned maybe as on average people are for a down year versus better positioned in the up years than on average other funds are?
I think that's fair. I mean, every down period has its own idiosyncrasies. It's a little different, but that's certainly the case when you look at how does your public equity exposure is a little bit higher than your peers, so that when the equity markets are positive, you're going to be on a peer basis, you're going to perform better. And a period where the public equity markets are punished, then you may do better than your benchmark, but both your benchmark and your actual performance might trail that of your peers because they've got less equity exposure. Yeah, that's correct.
If you look on page 23, there's a chart there showing returns versus standard deviation for, this one's for, I believe, 5 years. It runs pretty close to that even over the 10-year period. So we've done a very good job of putting together a portfolio that is providing really strong returns at less risk than what our, if we'd been all indexed would have been. So that's kind of your answer there.
Thank you.
Other questions from board members? Carl?
The next item on the agenda is this is just for informational purposes. This is just to let you know where we're currently at in our process for finding a replacement for Epic. So informational only. If everything goes as planned, we intend to bring you a candidate to interview at the next investment committee meeting. Any other question, I'll move on.
No. Trustees?
Can I get you to let Brian, Jason have? And then the next item on the agenda is discussion about a private equity fund series 2025 recommendation for Pathway Capital Management. Jason Clark is our lead portfolio manager covering alternative investments, and I have him here to discuss his document.
Thank you. Good morning. This is a recommendation for a Series 2025 investment with Pathway Capital Management. This will be the 5th series with Pathway. We also have 4 with GCM, you may remember. We now have a mature portfolio with more investments in the harvest phase, and I think John has talked to that a little bit this morning, paying distributions than we have in the contribution phase. Since 2022, the PERS private equity portfolio is cash flow positive, having received more distributions in that time than we have deployed, which is very good. As of Q3 2024, we have a net asset value of $3.8 billion with a net since inception IRR, which is internal rate of return, of 15.3%. And a TVPI, which is a multiple total value over capital paid in of over 1.84 times. So if for every dollar we've put in, we've received in value $1.84 in return. Upon reviewing pacing for the private equity asset class, it's recommended that we stay with the same commitment time frame, 3 years, and a dollar amount of $720 million, which is $240 million annually to the new series. In adding a new 2025 series, we would simply be a continuation through amendment to the existing limited partnership agreement, and is not a new relationship, so nothing would change in the relationship. In this new series, the only change recommended is an increase in secondary investments, which would allow them to go from 10% up to 15%. It's not a mandate that they do 15%, but it allows them to, if there is distress in the market, they could take advantage of those opportunities. One of the things I'd like to point out in the document provided, this one in there is, in working with Pathway, I asked them to put together some statistics I thought were very interesting. If you'll notice on page 2 is cash flow activity. This is cash flow activity of a mature portfolio. You'll see that distributions have outpaced contributions for the 5th consecutive year. Now, this is just Pathway, generating a net cash flow of greater than $850 million over that period. They have, even though the economy has been struggling, Mr. Breland, to your question earlier, they have definitely put forth distributions. Some of that is just opportunities. Some of it is that we are a mature portfolio, and at some point they have to sell them or realize those gains. In 2024, you'll see, again, was not necessarily the best year for private markets, but you'll see in 2024, distributions exceeded contributions by more than $185 million, marking the 2nd highest net cash flow amount recorded in a single calendar year for us with Pathway. Thought that was very interesting. On page 4, you'll see that each vintage year in the relationship since 2008 has significantly outperformed the benchmark by an average of 610 basis points. That is impressive. And on page 6 shows how since inception, the private equity program, again, which since inception was 2008, Pathway has outperformed the S&P 500 by over $529 million. That concludes my remarks.
That's impressive. I kind of like that myself. So what we have, I believe, is a recommendation from staff that we invest in a Pathway 2025 series of another $720 million.
That is correct.
Okay. That's a recommendation of staff. Any questions of staff concerning this recommendation? If I could have a motion then?
So moved.
Got a motion?
Second.
We have a second. Any further discussion? All those in favor say aye.
Aye.
Those opposed? There being done, none, it is approved. Charles. Let's see. I think the next item on our agenda is, it's not on there. Lunch.
But you're on the right track, though.
So, what time did you have these individuals scheduled to come in exactly?
We tell them 1 o'clock.
Okay.
So we're a little bit ahead of time if that clock up there is correct.
Okay, well, what I would prefer for us to do, if we're at 11:45 right now, let's aim for 12:45, and if they arrive early, we'll go ahead and
Okay.
take the first group.
And I have just a
in.
little bit of a change in presentation. Something came up that necessitated that Marathon present first. So they'll be coming up first, and then they'll move on to Arrow Street second. So they're all the same asset class, so it's, not taking anything out of
These
order.
are our international equity people.
Correct, yes.
Okay, and that'll be Marathon first, then Arrow Street, and then
And
Bailey
Bailey
Gifford.
Gifford, yes.
Okay. Any objections to that change? There's none to that, then what we're going to do is recess this meeting until approximately 12:45 for lunch. Recess.
We're sorry, your conference is ending now. Please hang up. Welcome to AT&T's teleconference service. Please enter your access code, followed by the pound sign. To join the conference as the host, press star. Otherwise, press pound. Please enter your host password, followed by the pound sign. There are 1 participants on the call, including you. You're joining your conference as the host. For a menu of available commands, press star pound.
order the continuation of our investment committee, and I believe we're at the point now where we're ready to hear from our international equity investment managers, the presentation. And I believe, Ron, you're going to give us a little update before we get started here.
Yes, sir.
Thank you.
So today we have the International All-Cap Equity Managers. It's Marathon, Air Street, and Valley Gifford. First is Marathon. We've been working with them since May 2016. For the past year, they've underperformed. Their return was 4.1%, and the benchmark was 5.2%. So about 110 basis points of underperformance. And that's in part because Marathon likes smaller and mid-sized companies, and that's just been a headwind over that time frame. For their 3-year return, they've outperformed the benchmark by approximately 50 basis points, and since inception by about 10 basis points. Next manager is Air Street. We've worked with them since 2013. They're a quantitative manager, and they've just been doing a great job for us since I've been overseeing them. For the 1-year period, they returned 10.8%, outperforming the benchmark by approximately 500 basis points. For the 3-year period, they outperformed the benchmark by approximately 530 basis points. And since inception, they've returned 8.62%, and that outperformed the benchmark by about 292 basis points. And then lastly, we have Valley Gifford. You may remember, I forget when, but I think it was sometime last year that we added them to the watch list. They're kind of, when they do well, they do really well. And when they're underperforming, it's by a lot. But for the last year, they returned 2.9%, and the benchmark returned 5.8%. So they underperformed by around 290 basis points. And since inception now, they've underperformed the benchmark by approximately 20 basis points. If y'all have any questions, I'd be happy to answer them. And if not, I can go get Marathon and let them start presenting.
Any particular reason why Valley Gifford, there's such a big swing in their performance? Is it their methodology, or is it because they're in Scotland, or I mean, what?
Or is it because of Butch McMillan or what?
Butch McMillan.
When Butch put them under.
Something to do with
Butch
this?
Put them under when he went over to visit them.
Yeah, I can say I don't think it has anything to do with them being in Scotland. But, it's just growthier managers, they have struggled the past few years. All of the quality growth managers we have in the portfolio are on the watch list right now or about to be on there. So that has caused headwinds. That doesn't explain all the underperformance to me, though. And that would be a good question to ask them, in their opinion, what has gone wrong for them the past few years. But, this is one that's been on my mind a lot lately since we put them on the watch list, because it's, we need to turn around quickly, or it'll probably be time to do a search and see what else is out there.
Okay, then we're ready to hear one. Charles, you got something else before we start?
No, I do have questions of my own for Valley Gifford, and I will definitely ask them.
Absolutely.
So,
All right. Well, thank you. I'll go get Marathon.
Marathon.
If I could, Mr. Chairman, just a friendly reminder for everyone to speak into the microphone when you can. If you'll make sure and tell the speakers, that'd be good.
How long does each group have?
It's usually around 20 minutes or so, yeah.
Good afternoon.
Good afternoon.
Welcome to the PERS board meeting. We're glad that you have arrived safely,
Thank you so much.
and I'm glad that we're able to provide some nice weather for you today.
Oh, I haven't seen that yellow thing in the sky for a long time.
Okay, we'll turn it over to you then.
Well, thank you. And I managed to log on earlier and saw that you had quite a substantial pack that you've put together. So I'm glad that in going out of order, I get you closer to the end of that pack. And what I thought I might do, if that's okay, and do please stop me for questions at any point, is just give you a quick reminder of how Marathon invests your assets. Talk a little bit about performance, some of the changes that have gone on over the last year, well, a couple of years since my colleague Brad presented to you with the team. But I wanted to make sure that I left plenty of time for questions, because I know there's a lot of headlines in the world at the moment, and a lot of interest in how we're reacting to that in your portfolio. So maybe if I could ask you to start on page 498 of the materials, or 29 of the Marathon materials. There's a slide entitled Marathon Approach, a Recap, where we talk about our capital cycle approach to investing. And what we mean by that is that we take quite a different approach to many investors. So I think the typical approach is to try and figure out what is happening over the next quarter or two in terms of a company's demand, its revenues, its earnings, and so on, and work out what to invest in from that. We kind of do the opposite. We take a long-term supply side view of the world. We're investing typically on about an 8-year time horizon. It's a little bit less than that at the moment because we've had some changes in the team. And our view is relatively straightforward, which is that if a particular industry is doing well in the world at the moment, then that will attract new capital. So, if you think about, I don't know, electric vehicles or something, that's been an area that's kind of taken off over the last few years in many parts of the world. Now, we don't know, and I doubt whether anybody knows, who the eventual winners are going to be. But we do know that that's attracting an awful lot of new investment into that sector. So returns for every company are probably going to come down. So whether the eventual winners are Tesla, whether it's one of these new Chinese companies that I don't even know the names of some of these companies, or whether it's one of the kind of traditional original equipment manufacturers based here in the US or in Europe or in Asia. What we know is that a lot of investment is going into that industry. Same with AI at the moment, and that will almost certainly drive down returns for everybody. So the chart that we have on the page, we invest in two types of businesses, either companies that we think can effectively beat the fade. So because they have a competitive edge, because they have for instance, a duopoly position in a particular industry, they can continue to make above average returns, above average growth rates for longer than other investors anticipate. So that's one half of the capital cycle, I guess, typically kind of growth or high quality stocks. The other half, the bottom half, are companies that are making lousy returns today, but because they're making lousy returns and every company within that industry is making lousy returns, then capital is probably going to leave. And that might be through companies going bust, it may be through takeovers, it may be through companies simply leaving that particular industry. And that means that the returns that are earned by the survivors should rise, and they often rise faster than the market expects, because I think investors typically will extrapolate whatever they see today and assume that that's going to continue forever. So our view is that that doesn't happen, and it's better to focus on these supply side changes and how management teams are reacting to that in terms of how they're allocating your capital, rather than trying to out-forecast everybody else in terms of demand. So that's the approach that we take to investing at Marathon. So we spend all of our time thinking about capital cycles. Where's competition increasing? Where's it decreasing? and how are management teams reacting to that? And sometimes you get management teams who are very good at effectively putting your capital to work where they can make the highest returns. And we're patient investors. We're investing on the basis of individual companies that we identify in companies around the world. But if I can speculate, it seems to me that the capital cycle probably applies to markets as a whole as well. And we've seen very good returns here in the US for the last decade or so. All sorts of capital has flown into US markets as a result of that, and other markets elsewhere in the world have been left behind. And maybe looking forward, the opposite will be the case. So we have relatively low valuations in markets outside of the US because of the experience of the last few years, where you've had higher growth companies here, particularly in the tech sector. And the kind of concentration that we've seen, particularly in the returns of large companies, may start to swing back. So the elastic stretches a long way. Valuation isn't the sole reason to invest in a stock or in a market, but at some point, history tells us that it does snap back. Maybe turning to performance, if I may. So I'm just scrolling through the charts here on 20 pages before that, I think. So we have the headlines on page 472 of your materials. And you can see that over the longer term, since inception back in May of 2016, we've done a little bit better than the MSCI All Country Index, which is your benchmark. It's been more of a struggle over the last 2 years since we last met here, but we've done a little bit better over the recent calendar years. And I think there's some more data on. Let's just check where that is. So on page 488, you can see it in annualized numbers, and the final column of each table shows you how we've done on a relative basis, gross of fees. Yes.
I was just going to say, if you would, I think you're probably scrolling from some of the information we make available publicly, but if you could call out the page numbers.
Oh, sure,
on
absolutely.
this, that'll be what the board.
Yeah, sorry.
Thank
you. So it's page 19 of the marathon materials, sorry, apologies for that.
No problem.
I thought I was being clever, and I'm too clever for my own good. So you can see on a kind of year-by-year basis how we've done relative to your benchmark, annualized on the left-hand side, and then on a cumulative basis across the top of that table there. The couple of pages before that, I think, are quite interesting as well. So on page 16, you can see how this strategy is done over the very long term versus the benchmark. So on a cumulative basis, and it's always the case with cumulative numbers, if you do relatively well over a very, very long period of time, then it really starts to add up over the long term. What we've done on the next page, 17, is look on the basis of 5-year rolling returns, because that's how we measure ourselves internally. That's how our portfolio managers are paid. Are they beating the benchmark on a 5-year rolling basis? I'm glad to report that most of the dots are above the line. So the line represents effectively if you'd have chosen to invest in a zero-cost index fund instead of investing with an active manager like Marathon, that's how you would have done. And the dots above the line represent us outperforming. I've highlighted a few areas there. So the kind of gold circle, you can see that we're only just beating the benchmark over the last 5 years to the end of December last year. It's been quite a tough environment for us, and I'll explain why in a second. The last time that we actually underperformed was at the end of the dot-com boom 25 years ago. And you can see that kind of underneath the bar there. And then, of course, we bounced back very strongly after that. And I would argue that this is a somewhat similar position that we're in stock markets around the world today. And On 18, you can see how we've done in up markets and down markets. So since inception on the right-hand side of this strategy, that is, so that's going back to June 1994, we've beaten the market roughly 6 times out of 10 on average by 0.6% a quarter. But you can see that our hit rate has been better when the market is down than when it is up. And although the market tends to go up, what you do on the downside is important in terms of preserving your capital. The other one that I've wanted to highlight, if I may, is how we've done in environments when the market has been favoring large companies versus small companies. And on page 25 of the presentation materials, you can see data for the last 3 years to the end of 2024 on how small and mid-sized companies have done in various markets around the world. We've included the US market for completeness, even though we don't invest in the US in this particular strategy. But you'll see that in every market around the world, the UK being the worst, small and mid-sized companies have underperformed large companies. And I think in the US, it's fairly obvious. It's all about technology. You know, the so-called Magnificent Seven have been dominating returns. They've got bigger and bigger. And it's arguable that, that they've done so because they produced better earnings growth, better returns than the average business within the S&P 500. That isn't true elsewhere in the world. So you've seen the same effect where you've seen a handful of larger companies get bigger. It's pharmaceutical companies, it's energy companies, it's some consumer companies. But those businesses have not been growing their earnings faster than the average company. So it's all been driven by the valuations of those businesses getting larger relative to their peers. Now, I mentioned this, hopefully it doesn't come across as kind of special pleading, but at Marathon, we tend to focus on smaller and mid-sized companies. There are a lot more of them in the world, so the opportunity set is substantial. And that's an area of the market where we've had great success over time in identifying businesses that are, undervalued by the market. Maybe they're not followed by as many, but by as many other firms, as many stockbrokers. And as a consequence, we can make good returns on your behalf by investing in them. I'd say there's also been, and this is a lesser effect, but over the very long term, investing in smaller companies, which tend to be a little bit riskier, they tend to be more volatile, has also been a bit of a tailwind because smaller companies have performed better than larger companies over the very long term. That hasn't been true over the last decade or so. We think it probably will be true again going forward. And that's a significant skew in your portfolio. The other areas that I just wanted to focus on briefly, if I may, are the team. So on page 9 of the materials, we've kind of listed the portfolio managers who are responsible for managing your assets. And at Marathon, we're organized by region, and individual portfolio managers will be responsible for a sleeve within their particular region. And what's happened over the last couple of years is that we've had a couple of retirements. So Neil Ostra, who was one of the founders of Marathon, retired about this time a year ago. And then a gentleman called Simon Somerville, who was a portfolio manager in Japan, also retired. That has given us the opportunity to concentrate a little bit more so that your portfolio isn't quite as diversified as it had been previously. And you may have noticed, and I think it's on one of the pages prior to this, so on page 4, we show some turnover in your portfolio, which is a little bit high for Marathon. Typically, we've had a holding period of about 8 years of the average stock in your portfolio. It's now down to about 4 or 5 years, and that's because of the changes in the team. Obviously, when one portfolio manager retires, then those who take on that individual's assets, the responsibility for managing your assets, they may have different preferences in terms of what they want to own in the portfolio. The other thing that I would highlight on this page is that the number of holdings has fallen quite considerably. So it was just under 300 holdings back at the end of 2023, 245 at the end of last year. It was probably 350 a year or two prior to that. So we've been concentrating a little bit more. We want to make sure that every position has the potential to make a positive impact on your performance returns over time. And the individual holdings are on the next page 5. You'll see that we've had to use 4 columns of very small print to list all of the sales, 1 column to list all of the new holdings in your portfolio. I think that was it in terms of my prepared comments. Very happy to take any questions that anybody may have at this point.
Who would have comments or questions at this time? I don't hear any comments at this time, or questions, actually. So
perfect.
We appreciate all the work that you have been doing for us and for our fund, and the good work that you've done. And I know you got the headwind with all those small and mid-size.
Well, we thank you for entrusting us with your assets, and hope that next time I come in a couple of years, we'll be able to report some great returns for you. Thank you very much.
Thank you so much.
Is he stationed in England? Is he from England?
Yes.
Yes, they're in
Yes.
London.
He Jackson, Mississippi, PERS.
We're pleased to be
We're
here.
glad that you are here today. Just a reminder, if you would, make sure you speak into one of those microphones. Everybody else here hears well except for me, so I need to remind you of that. So we'll turn it over to you all.
Great. Well, good afternoon, and thanks for having us. We're from Arrow Street Capital. My name is Judy Donovan. I'm the relationship manager for you all at Arrow Street Capital. And I'm joined by Carlos Antoneda, who's a senior member of the portfolio management team. So I was just going to spend a few minutes talking about a couple updates on the firm, and then turn it over to Carlos to talk about what's going on in your portfolio. But before I do that, I just wanted to acknowledge that in June, it'll mark our 12th anniversary with you all as being your investment manager. So we wanted to thank you for your partnership and look forward to continuing that. So with that, from a firm level, everything at Arrow Street has been going quite well. There are a couple of things that I wanted to mention to you. One is that you may be aware that we closed to nearly all cash flows last year, back in April. And that is something that we do because we want to make sure that the assets that we take in don't make us less likely to achieve our target investment results going forward. And so we closed down, and for about 9 months, we did a study of what was happening as we were investing the funds that we have currently under management. And we found that we didn't think it was impacting us at all in terms of being able to generate returns. And so at the beginning of February, when we made the decision to reopen our broadest ACWI strategies and our US dedicated strategies. The other point from a firm level that I just wanted to mention was that, again, in January, our Chief Executive Officer, Tony Ryan, announced his intention to retire from the firm at the end of 2025. So Tony has been our CEO for the last 10 years, has been with the firm for 13 years. He'll be 62 at the end of this year, so it's a good time for him personally to pivot to some other interests. But I think he is also very comfortable with the state in which he's leaving the firm, and very confident in our leadership, in our ability to continue to innovate. So again, that we can focus on delivering investment returns. Tony will remain on the board of directors of our firm after his retirement as a non-executive director. And we're right now in the process of identifying his successor. So we expect that by June we'll have a sense for who will succeed him as Chief Executive Officer. We're looking at both internal and external candidates, and then giving them a nice 6-month period of time that they can overlap prior to Tony's retirement, and have a nice long transition period, as we typically do in these sorts of situations. So those were really the two things that I wanted to say from a firm perspective. If there are any questions, I'm happy to answer those.
Continue.
Great. I'm going to turn it over to
Thank you.
Carlos.
Thank you, Judy. My name is Carlos Ontaneda. I'm a senior portfolio manager on the portfolio management team at Arrow Street, and it's a pleasure to be talking to you all today. I'll begin quickly with an overview of performance. So for the 2024 calendar year, we added 5.02% in value add in the portfolio, ahead of our investment objectives. It's always satisfying to us to be able to deliver performance at or exceeding our investment objectives. And the number for since inception returns, as Judy mentioned, marking that 12-year point since mid-2013, is 2.92%. So again, ahead of, and both of those numbers net of fees. So we're happy to have delivered, again, at or in excess of our objectives. I'll give a quick summary of our investment process at Arrow Street. So Arrow Street is a firm that formulates fundamental investment ideas. Think of these ideas as the type of ideas that a good fundamental analyst might have for determining whether a company is an attractive investment or not. The difference in our approach is that we then deploy these fundamental ideas in a systematic or quantitative fashion, meaning that we can deploy them over a very large universe of stocks and take advantage of expressing these fundamental views in a very diversified but also disciplined way. The types of ideas that we're going to focus on specifically have to do with information that is helpful for predicting future fundamentals and therefore price moves about companies. But critically, that information must not be widely appreciated, must not be terribly obvious to other market participants. If it is not obvious, it will be easier to exploit. If it is obvious, it might not lead to any particular returns because market participants will act on that information very quickly. So in a nutshell, in a very brief nutshell, that is our approach to investing. In terms of the returns for 2024, most of the value add in the portfolio came from decisions that we made to over or underweight specific country sector baskets of stocks. So we can think of things like Italian financial stocks, Dutch technology stocks, and the decision to over and underweight these baskets was responsible for most of the positive performance. Decisions selecting individual names within an individual basket, think of individual names that we might under or overweight within Japanese technology stocks. Those decisions did not add a material amount of value in 2024. Over the long term, however, we do expect that both of these sources of returns are valuable in generating value add over the long term. In terms of how those returns were generated. I will mention that some of the big drivers of those decisions included Italian financial companies that we were overweight, particularly banks. We were also overweight, in my example I mentioned, Dutch technology companies, so overweight both of those. We were also underweight several sectors within countries. In France in particular, we were underweight consumer discretionary and consumer staples, and that added value. And we were also underweight Danish healthcare companies. So those decisions in developed markets were very beneficial. And in emerging markets, we also added value. That was through overweights primarily to Chinese stocks, financials, technology stocks, and also in Taiwan, which I note are overweight in Taiwan. Taiwanese technology stocks benefited from the enthusiasm for AI stocks over the year. In terms of how the portfolio is positioned, currently, we are overweight emerging markets and we are underweight developed markets. In terms of our overweights, I'll start with emerging markets. We are overweight China and financials. That is motivated by extreme sentiment signals. So these are the types of signals that look for excessive sentiment, excessive enthusiasm in the positive direction and take the opposite view, or look for excessive negative sentiment. Maybe prices have gone down too fast, and again, take the opposite view. So it seems like some of the negative sentiment in China seems overdone from the point of view of the signals that we use. In Korea, we are overweight financial stocks. That is based on valuations. So we see Korean financial stocks as relatively cheap. And in Brazil, we are overweight energy stocks. That is also on valuation. So we see Brazilian energy companies as cheap. In developed markets, we are overweight, broadly speaking, Italian and Dutch stocks, the same sectors that drove performance, namely Italian financial stocks and Dutch technology stocks. And those are really, those positions, those overweights are driven by price trends. So favorable price trends in those stocks that we see as continuing. In terms of the underweights in the portfolio, our largest underweight is in emerging markets. In India, we are underweight Indian stocks across multiple sectors. That is on the back of valuations. We see Indian stocks as expensive and unattractive for that reason. And we are also underweight French stocks on price trends, so unfavorable price trends in France. And finally, we are underweight Australian stocks, concentrated in a few sectors, materials, and some others, and that is due to extreme sentiment. So in Australia, we see very positive sentiment that we see as overdone, and therefore have taken that underweight position. So that concludes my prepared remarks in terms of portfolio performance and positioning, but happy to answer any questions you may have.
Any board members or other members seated at the dais here?
Can you spend a moment just talking about dominant factors that you have within your model? So when you look at the might be political instability, how is that incorporated into your model?
Yeah. So in general, we try to, in the same way that we try to achieve diversification in forming views across many, many names, we also try to achieve a lot of diversification in the types of signals we use. So we try to have a great many signals in our model, and these signals, using different type of information and capturing different effects, help each other out or diversify each other. We don't have signals directly that are related to macroeconomic turbulence, although we pick up those things through the impact that that turbulence might have on earnings, the impact that that turbulence might have on sentiment. So, we measure sentiment in terms of short-term price trends, but we also measure sentiment by, for example, looking at text data from news sources. So is the sentiment, for example, in news articles positive or negative? So we try to capture the impact that these macroeconomic events may have through these different varieties of signals. We in general find it difficult to predict large-scale macroeconomic events, so we don't try to predict surprises or shocks that may occur, but we have found that our process reacts to these shocks fairly well, because these shocks often give rise to big dislocations. The dislocations give rise to mispricing of securities, and our signals, this diversified set of signals, are actually fairly good in our experience at capturing these dislocations and taking advantage of them.
Yeah, one question. Given your quantitative approach and large data sets, have you found applications for AI in your portfolio management?
Yeah.
And whatever you can tell us how you're utilizing that today and in the future.
Yeah, absolutely. So I'll begin with how we are using AI, but I'll also mention how we're not using AI. So the first way we're using AI is, a good example is the point I made in the previous question about the use of text data. So AI methods allow us to extract much more information from textual data than was possible even just a few years ago. It's richer, it has more context, there's just more information that we can extract from it. So we use AI in general to process information, and a good example is text data, but there are other ways we can use AI to clean data and to make it more relevant to our decision process. We also use AI in terms of just enhancing productivity. So our researchers, as you said, they need to go through very large data sets, complex data sets. So AI is very useful to speed up that research process and hopefully accelerate the time that it takes to test a new idea and introduce it into the portfolio decision-making process. Where we do not use AI is to come up with the investment ideas themselves. So we're very strict about being rooted in fundamental-based decision-making. So the source of the idea, is this piece of information going to be useful in predicting the future return of a company? That has to be something based on economic, financial reasoning. We're not going to throw a bunch of AI, a bunch of data at an AI model and have that model come back and tell us, well, this is a good signal, or this combination of data is a good predictor, because we would not then have the intuition as to why it works. And financial data is very noisy, so that intuition, that understanding, is almost as important, I would say, as the empirical results. So for that reason, we don't use AI to formulate investment ideas.
So what methodology do you use in testing AI or validating the AI information that you're getting?
Yeah, that's a good question. It's a difficult question. I think typically when it comes to, the example might be, I think in the last example I gave, if you were to use AI to try to generate some ideas about what might work, I think that would be difficult, because the intuition, you'd have to kind of back out some intuition, or maybe craft a story or something after the fact, but I don't think you would be quite sure as to whether it worked or not, which is why we don't use it in that context. In the context of something like a signal processing, for example, if you want to extract information from, let's say, a press release that a company makes, and you're using a more sophisticated method, well, I think once you've extracted the information you tested this AI model that can extract that information, you can then actually just read the text and see if the AI-generated summary or the AI-generated data corresponds to what might just be a plain language reading of that text. So I think in those cases, I think it's a little bit easier to evaluate whether or not the AI model on the text is giving you something reasonable. In more general cases, in terms of you're going to use AI to help you process some data, or you're going to use it to help you set up an empirical test, that's straightforward, because you know what you want to do. You just don't want to spend maybe 2 hours coding up that test. If you give it to the AI and it shortens that from 2 hours to 15 minutes, as long as the code performs as expected, it will be a useful productivity enhancement.
Other questions? Only have one other question. Is there any correlation between your success and the season records of the Red Sox? Or can we draw anything from that?
I believe would be underperforming now if that
Maybe your
was.
success against the Yankees.
Negative
I don't
correlation?
know. but that would be good.
We might
Any
have,
other comments for us?
we might have to study that. No, no comments. We'll take that back. We'll perform a study on it.
We thank y'all so much for coming down and sharing with us. Appreciate your work that you've done for us over the last few years here.
Thank you very much for the relationship, and thank you for working with us.
And I hope the weather was a little bit warmer here than it was home.
I just mentioned to Charles, we're happy to be here, so
Y'all
happy
have
to
a
stay
great day
longer.
here. Thank you.
Thank you very much.
Kind of performance, not a whole lot of questions asked.
I want to know which one of you is on that surfboard on the cover photograph there.
If only.
I mean, is that snow on that photograph as well, or is that?
There's definitely some artistic license there.
I know you're a pretty good ways north, but we appreciate you all being here with us today. We hope you're enjoying the weather while you're here.
Yeah.
Good. So I guess, Rebecca, we'll turn it over to you. Okay.
Well, good afternoon, and thank you very much for the opportunity to present today. I'm delighted to be joined by two of my colleagues, Joe Faraday, who many of you will know well, as Joe is one of your portfolio managers and has been since you first appointed us in 2014. And I'm delighted to introduce Tom Wright, who is an experienced client director at Baillie Gifford and recently joined me on your account. And as a reminder, I'm Rebecca King. I'm a director at Baillie Gifford with a focus on our US public plan clients. And I've had the pleasure of working alongside Charles, Ryan, and meeting many of you at conferences over the past few years. Over the course of the next 20 minutes or so, we plan to share with you a reminder on Baillie Gifford and our investment philosophy.
Let me just share with you, we do have all of us have your information. If you'll just tell us the page number, we'll be
I
able to find
certainly
it.
will.
Okay.
No, that's not a
Thank
problem.
you.
Not quite there yet, but I will definitely keep you posted. So over the course of the next 20 minutes or so, we plan to share with you a reminder on Baillie Gifford and our investment philosophy, discuss our underperformance and our lessons learned, and crucially address why we believe that we can once again deliver strong long-term returns for you. If you have any questions, please do interrupt, and of course there will be time at the end. I'd like to begin with our relationship with PERS as highlighted on page 2. We greatly value our more than 10 years that we've been working with PERS. And I'd like to just take this opportunity to thank you on behalf of all of us at Baillie Gifford for your continued support and patience, especially over the past few challenging years. It's important that we acknowledge upfront that our long-term delivered returns have quite frankly not been good enough. It's not what you should expect from us, and it's not what we expect of ourselves. This is the first time that we have presented to you where your since inception returns with us have lagged the benchmark. And this change has been driven by the weak performance over the past 4 calendar years, which has been especially disappointing. However, We strongly believe that we're very well placed at a firm and portfolio level to once again deliver strong long-term outperformance for you. And we plan to share with you today why you should have confidence that we can do this. Lessons have been learned over the past 4 years. And as a result, we have made some enhancements to our team and our process. But the key thing for us to do now is to stick to our proven investment philosophy, which has served our Baillie Gifford clients very well over the past century. You hired us in 2014 to select a differentiated portfolio of the very best international growth ideas. And we believe that your portfolio has never looked as attractive as it does today. History has shown us that ultimately, over the long term, share prices follow company earnings. And market signals are indicating to us that once again, share prices are starting to be driven by company operational results. This is evidenced in your portfolio performance over the past 9 months, which is your current financial year to date, as your portfolio is 1.5% ahead of its benchmark. And we believe that this uptick in performance will continue, driven by the strong fundamentals exhibited by your portfolio. Before I pass to Joe to go into performance and our enthusiasm for your portfolio as it stands today in more detail, I'd like to briefly turn to page 3 to provide a reminder of what we at Baillie Gifford can offer you, our clients. Since 1908, Baillie Gifford has operated as an Edinburgh-based, independent and unlimited liability partnership. Now, this is a unique structure in our industry today, but one that we will retain because of the stability it provides our firm and, crucially, our clients. Being independent enables us to focus truly on the long term in all that we do. We're not distracted by quarterly results to external shareholders, but we are solely focused on delivering strong, long-term outcomes for our clients. Alignment is essential, and our success is directly tied to that of you, our clients. So with that, I'll hand over to Joe to get into the portfolio and performance in more detail.
Okay, great. Thank you, Rebecca. Good afternoon, everybody. It is great to be here in sunny Jackson. I want to share with you a very brief recap on how we go about investing and our approach. I want to major on the very important topic of performance, and perhaps just as importantly then hone in on the portfolio and the outlook and why we're very upbeat that things have turned and we're optimistic about the future and what lies ahead. I'll use slide 4 as a reference point to start with on our approach or our core philosophy. We've got a tried and tested approach. This has been enduring. This we've applied for you since you appointed us over a decade ago, and it actually dates all the way back to the 1980s, which was the genesis of this strategy. And there are 3 hallmarks of our approach. It's about growth, it's about bottom-up stock selection, and it's about focusing resolutely on the long term. So we believe in looking for companies that will be significantly larger in years and decades to come. Dovetailing on Rebecca's comments, there are many a study out there that proves that the companies that grow their earnings and cash flows well in excess of the market are the ones that ultimately go on to deliver good long-term performance. So we obsess, we major on our investment style is looking for growth. The second strand is company specifics or being bottom-up stock pickers. We invest based on corporate attraction. We get to know companies exceptionally well. We have well over 100 investors. We meet over 4,000 companies a year. We do very robust due diligence. We'll back what we believe are the very best businesses, and that's what's held in the portfolio. And then the due diligence process about whatever we bring into the portfolio as well is extremely robust. That's the second strand. The third one is about being long-term. So this flows through from the laurels of Baillie Gifford and our long history. We believe it's about alignment ultimately with you and our wider client base. But when it comes to the portfolio, we're backing companies for years, if not decades to come. So we think 3, 5, 10 years out. We think that is in stark contrast to the average market participant who's thinking about the next quarter, maybe the next week, the day, the latest news beat. So we're turning time to our advantage. We think patience gets rewarded. So it's those three hallmarks that we see as being the ultimate driver of what we can deliver for our clients over very long time frames. Now on slide 4, I want to draw your attention to the chart on the bottom right-hand side, the turnover of a typical international all-cap portfolio. So this is over the past decade. You can see it's a squiggly line that then rises up towards the right-hand side. It's normally between that 10 to 20% band. That's commensurate with taking a 5 to 10 year view. Now you can see there's a very notable uptick to in excess of 30% over the last year. That's a function of a few reasons that Tom and myself will come on and expand onto a little bit more later on, but in summary, we're seeing a huge range of new opportunities out there. Idea generation has been extremely strong. We've taken some quite concerted action in maneuvering the portfolio into a wider set of growth types. And also, to be completely blunt, sell discipline, we've really raised the bar. We've got rid of what we've seen as being some problem children stocks in the portfolio. So it's about being long-term, applying that tried and tested approach, but it's also having that willingness, that resolve, or that evolving our approach as well at these times. So that's my main message on approach. If I turn to slide 5, how does this manifest itself? Ultimately, what we're trying to do for you is invest in world-class businesses. They just happen to be international. So to give a few examples, the world of NVIDIA and Apple quite simply wouldn't be the same if it wasn't for the likes of TSMC, Tokyo Electron, and ASML. So TSMC, the Taiwanese semiconductor manufacturing company, is the world-leading foundry business in semis. Tokyo Electron in back-end equipment. ASML is the world leader in lithography. These have been pivotal to the advancements in the supply chain or the processing of semiconductors. Another example would be transformative medicine. Or if you just quite simply think about the likes of Pfizer and Lilly, the success of those businesses wouldn't have been the same if it wasn't for the likes of Lonza and Sartorius. Lonza is one of the biggest providers of R&D capabilities to all the biopharma companies. Sartorius is one of the world leaders in all the equipment that all of these companies use in their R&D and production processes. The list goes on. On the right-hand side, there's consumer goods companies. In the emerging markets complex, we have anything from LVMH, which is Louis Vuitton Moet Hennessy, so one of the world leaders' collection of luxury brands. So anything from handbags all the way on to the likes of beer companies. There's AB InBev, which is the company behind Budweiser. These are formidable brands. These are world leading in the areas that they operate. The last comment would be around some of the industrial companies. There's a company by the name of Atlas Copco. It's well over double the size of the Ingersoll Rand, the US counterpart. Atlas has kitted 9 out of 10 factories around the world. Factory automation or production lines wouldn't be the same if it weren't for this business. Now, I could go on with countless examples, but my main message here is these are exceptional companies. They're growing, they've got a strong edge, they've got aligned management teams, and ultimately that combination of growth, stock picking, and long-term, this is what we're trying to identify for you in your portfolio. So that's on our approach. If I now turn to performance, there are 3 reference slides in the pack, slides 6, 7, and 8. But I basically want to make 3 key remarks on performance. I'll echo what Rebecca said. Performance hasn't been what we wanted to deliver for you. It's been a really tough and torrid past 4 years. What is that down to? I'd cite 4 very specific factors. Sure, we've made some mistakes. There's been stock names that haven't really fired or worked out. But the 4 main factors I would cite as being what's happened in Japan. We've had a big rally in the value-orientated stocks there. That's been at complete odds with the high-quality growth companies we selected and had in the portfolio. So they've underperformed significantly. The second factor would be China. There's been a sharp derating or sell-off in the high-quality growth stocks from that market. The third factor would be a strong dollar has acted as a very big headwind in terms of translational impact, but also from the likes of the Latin American holdings that we have in the portfolio. So those would be the 3 factors I would cite as having been led to the underperformance of the past couple of years. That came on top of the 4th and perhaps what also key factor from 2021 and 2022 was the rollover from COVID. So this is a portfolio that enjoyed and had very strong performance going through COVID. But then what ensued when you had sharp rate rises in very short order, high inflation, supply chain shocks, geopolitics coming to fore, there was a very marked derating and underperformance of the portfolio over that time. So I would cite those as being the 4 factors, top-down factors, that led to the degree of underperformance that has been seen in the portfolio. So that's my first main point on performance. The second one, if we look today, and actually if I cast my mind back to almost about a year ago, what we've seen since last summer, we've actually been broadly encouraged by what we're seeing in terms of performance. We're slightly ahead, year to date is positive. But underneath that's what's even more important. Operational performance is coming through, and we believe significantly so for the holdings that there are across the portfolio. Top lines are growing well in excess of the market. Profitability levels are high. Return characteristics are very, very strong for the portfolio. Share prices will follow fundamentals. We think that this will ultimately get fully reflected, and it's about patience to see that now coming through with time. The other last point, the third one I want to make on performance, is regressance. I'm going to turn to slide 8. And there's quite a lot going on this slide, but my point here is trying to reference long-term performance and cycles that we and everybody will see. I'm going to ask you to look down towards the blue bars, and this is the rolling 5-year performance that this strategy has seen all the way back to the mid-2000s. And as I've cited, you can see the sharp underperformance that we've seen in recent years towards the right-hand side, and you can see a similar period about 17, 18 years ago, stemming from the mid-2000s for a few years. And then what followed was very, very strong performance. Now, this is a strategy. I joined this team in 2007. It was a really tough period back then. But we stuck to a consistent process. We put in place enhancements. We got through it. It took patience and it took conviction. Today reminds me of where we were back then, and then what followed was a very strong period of long-term performance. So those are my comments on performance. Now, why should you have conviction in that? Between myself and Tom, we're going to outline 4 main reasons that we're excited and upbeat about the portfolio where it is today. The first of those is on slide 9. This lays out all the 80 or so holdings that we have across the portfolio. In my earlier remarks, I talked about some of the assertive action we've taken to bring through new names and let go of other names in the portfolio. This helps as a proof statement of that. NB, all the names in dark blue, are new buys. So some assertive action, bringing forward newer, different growth types into the portfolio. All the names in the bottom right in the striking red are names that we've sold and moved on from. So rigor applied, letting go of those businesses. And what we've done over the last year or two is deliberately maneuvered to ensure the portfolio has a wide range, a broad range of growth types, and we aren't too narrow in our conviction. So those 4 broad buckets on along the top. There's compounders, which is about 1/3 of the portfolio, so durable growers, that's about a third. Cyclical growers is about 1/3, so the industrial type businesses there. The rapid growth column and the capital allocators are 1/3 combined. But one of the biggest changes has been reducing that rapid growth proportion and almost adding to these other wider varieties of growth. We think that gives the portfolio far more diversification and more confidence in how this growth will ultimately come through and get delivered on with time. The next point is with reference to slide 10. There are 4 specific areas we think performance can be unlocked from that we're seeing at these times. The first of those is internet platforms. There's industrials, consumer goods companies in Japan. Internet platforms over the last year have been performing extremely well in operational terms, and that's coming through in share prices. That's exactly what we want to see, and we believe it will continue. One example there would be a company called Spotify, the music streaming business. Now, to help outlay the backdrop there, this went up 4-fold before COVID. It fell by a factor of 4, and then it's doubled over the last year. We think the trajectory for this type of business is really encouraging. These are very strong businesses. They're growing top line, they're growing users, they're monetizing, they're profitable. We're excited about the backdrop there that is coming through at these times. The second grouping would be industrials. So I mentioned that company earlier, Atlas Copco, but another example would be Air Liquide and industrial gases. These have had a really tough few years. CapEx spend, industrial spend has been quite low. We think that now returns. The market's been very short term and almost sort of fed up or frustrated by the lack of growth coming through for these businesses. we think that's about to be unleashed in a significant manner. In the emerging market consumer complex, I touched on the luxury goods companies, the beers companies, but we have companies that do diapers, detergents, pharmacy chains, supermarkets. These are all going to be big beneficiaries of the rise of the middle class and the demographics that are very, very favorable across emerging economies. So we think that's another driver of performance that is coming through significantly so. And the last one will be Japan. It's been a really tough market. All the obsession has been about value. Japan has some truly exceptional companies. We believe in the high quality growth companies. They will grow, they will deliver, and we think that performance will ultimately get rewarded. So I'm going to bring in Tom. My summary is it's a tried and tested approach. There's consistency, but also enhancements. Performance has been tough, but we're seeing short-term improvements, and it's about having that patience and conviction to stand by our style and navigate through cycles, and firm conviction in where the portfolio is today. Tom.
Okay, thank you, Joe. So page 11 just shows the hard numbers behind the portfolio. It's the evidence that supports our belief that it's going to outperform very well from here. We said at the start that companies that can grow their earnings faster than the market as a whole will outperform. And you can see in the chart on the left that your portfolio is growing almost twice as quickly over the forthcoming 5 years. Not only is it growing more quickly, but the second bar shows you that that growth is going to be much more profitable. So return on invested capital is half as high again as that of the market. So those earnings can be reinvested profitably into further growth. In an uncertain world, it's obviously important that these companies are financially very strong and they've got good balance sheets. You can see here that they've got about half as much debt to equity as the market as a whole. So this gives them more resilience and more flexibility to manage whatever politics or economics throws at them. And finally, you would expect to be paying, a certain premium for companies with this quality. And you can see on the right-hand side, yes, you are paying a premium, but we think that's well worth paying up for, I say, for the quality and for the potential of the businesses that Joe was discussing. And this on page 12 shows really the second reason why we're confident of performing much better in the future. It's partly because we've been trying to learn the lessons of not only the last 4 years, but of everything we've done since the inception of this strategy. The first thing we've not done is change the underlying philosophy. So we're still very much long-term, we're bottom-up focused on stocks. We're very comfortable being different to the portfolio, to the market as a whole. That's the only way to outperform. And also we're still very focused on growth. So I hope that still fits in well with your other lineup of managers. But apart from that, we are very unchanged from the managers you hired just over 10 years ago. What we have also done, though, at the same time is to invest both in Baillie Gifford as a business in terms of technology and people, but also specifically in this strategy that you're invested in. So we've added some resources to the team to support Ian and Joe. And this has helped to sharpen decision-making. It's helped to deepen our research process. And I think it's also made us more responsive to market moves. Because we do admit we have seen too much volatility from the portfolio, both on the upside during COVID, but also on the downside since then, which effectively wiped out the first good 6 years of performance that we did deliver for you. So what we're hoping is that with the support of an independent risk team who provide extra analysis and challenge, that you will see far less volatility in the future. So, and as Joe said, we're looking to invest in a much wider range of businesses, covering everything from semiconductors to quite niche retailers in the UK, Europe, and beyond. So it will be a broad range of growth businesses in your portfolio from here on. So page 13 just sums it up, really. That's thank you again for your patience and support over many years. We are sticking very much to our philosophy, but obviously there are lessons to be learned, and we're looking at those and taking action where necessary. And what you've ended up with is a portfolio of, we think, are exciting, world-leading companies which are trading at very attractive valuations. And people quite often ask, when is performance going to get better? I mean, that's an almost impossible question to answer, but we are seeing it come through better in more recent terms. Share prices are beginning to respond to the good operational performance that Joe was talking about. So thank you again for listening. and very happy to take any questions.
Okay, Charles, go ahead.
As you can imagine, it's been, and I'm not trying to pick on y'all at all. Please don't take it that way. That has been quite distressing that, since 2021, y'all's performance has been a significant step back from what your longer term track record had been. And over the time, I did notice that you were making tweaks to your overall attribution. Hasn't changed much from what you would expect your portfolio to look like, and your positioning. But what areas are you focusing on and changing in that positioning? To make sure that this doesn't happen anymore. And you've mentioned a number of times lessons learned. Can you give me a few of those lessons that you've learned? So, again, not trying to pick on you. Just
Yeah, no. Well, you don't even use the word pick on. Performance has not been acceptable. We feel that. We know you feel that. We're fully accountable for that. Lessons learned. With the benefit of hindsight, we got too narrow. We went after very high levels of growth. If I go back to slide 9, the shape of the portfolio, about a third, almost up to 40%, had maneuvered itself or done extremely strong in share price terms, and we'd added to those names in the rapid growth arena. The brakes had gone on at that time, but we didn't take enough assertive action. We didn't pull that back. We didn't ensure there was this broad breadth, diversity, roundness of the portfolio. So in the good times, it was great, but was there the extent to sort of the downside protection, the robustness, the resilience, or the ability to safeguard against volatility being built into the strategy at that time? That's I think you can cite that as being one of the biggest structural challenges. And then what followed with the unwind of COVID, with high interest rates, inflationary shocks, etc. I don't think I could sit here today saying we were never going to underperform in that type of market backdrop, but the extent of the underperformance was quite significant or savage. It's then followed, there's been some other broader, wider market events across international. It seems markets world overall behaving very, very differently. For the likes of what's happened in Japan, I think it's been almost remarkable that the value rally there, and that's been at complete odds. So these things have come along in fairly sharp, short succession, and we think that pattern of events is very, very irregular. And that's where I turn back to I think the important one is slide 8, which is that very long-term record. We actually have this for a slightly different variant of the strategy that doesn't have emerging markets going all the way back to the 80s. And you can see there will be cycles. Cycles happen in life, they happen in markets, they happen in investment managers, they're going to happen for individuals as a manager. So it's about the wherewithal, having the patience, the conviction to navigate through that. So I just want to share those high-level comments. Now, you asked about lessons learned, so what as a result of that? For us, for Ian, myself, the whole team, it's much more about now the breadth and diversity of growth types. And let's safeguard against getting too narrow. So, for example, over the last year, we've brought an energy major. We've been buying some banks. We've been searching high and low across these sectors to make sure there's no neglect. We will look through each and every area of that wider opportunity set and identify what we firmly believe are the good companies. So the bar is still high for those, but let's not get too myopic or too narrow in our view, and safeguard against, if those types of stocks do well, that we have the suitable levels of exposure to be able to deliver good long-term performance as a result of that. Another one lesson I would just cite, and Tom commented somewhat on this, it's the relationship you have with your investment risk team. We have an independent investment risk function, and it's fine. They can come in to do a formal quarterly review. But it's also about how you work really collaboratively and with those individuals. We've had the risk analyst for the best part of 2 years now, and each and every one of our monthly portfolio meetings is literally on speed dial for me. And I think it's about working and complementing and using that skill set, that vantage point, to help you think through and add additional rigor to the process that go back 3-4 years ago, we'd probably drifted somewhat away from that. So I think those are some quite open comments about what happened. and some of the lessons learned. And I can expand or get very narrow, specific on lessons learned, but I think that gives an illustrative example of that.
Other questions?
Obviously, 4 years of underperformance like you've experienced and the soul searching to determine, what could have been done differently, right? It is kind of a tough exercise. When you went through that analysis, I think I guess my question is the lessons. In 2019, you outperformed the benchmark by 1,200 basis points, and then 2,200 basis points in the subsequent year. So some of the weaknesses, I guess, in your process contributed probably to your success at that point in time in terms of that narrowness, right? And then it becomes a question of, okay, where do you overlay the risk to in one aspect, it might disturb that pattern of returns where you're not going to experience that same excess. And what did that look like in terms of going forward? What can the expectation be? Like, yeah, less volatile, less narrowness. Okay, well, when you look at the less narrowness, do you think over a full market cycle, both up and down, you think you've got considerable outperformance as a result of that?
Well, if I could just chip in first, the objective of the strategy has always been to beat the index by 200 basis points over rolling 3-year periods. Now, it obviously got ahead of that in the pre-COVID years when we outperformed by too much, and then arguably we've been underperforming by much too much over the last 4 years. But what we would hope from talking about broadening out of the portfolio and doing more work with the risk team who are challenging and analysing the portfolio, that we move back closer, much closer to a +2% outperformance per year over the long term. Now, it's not going to come in a straight line. There's still going to be some good years and some underperforming years, but we do not expect you to see the sort of levels of either outperformance or underperformance that you've seen in the last 5 years in the future.
I think the only thing I would add, John, in sort of risk speak, I think of information ratio of 0.4, so outperforming by 2%, tracking error of 5, and can we deliver that in excess of 2/3 of the time? Can we aspire to that approach and the portfolio behaving in that way? So it is, it's almost crimping around the edges, so we don't see the levels of the excesses, but we also don't see those very significant drawdowns or that whiplash in performance. And this almost goes back to the portfolio a decade ago that PERS and others appointed us for, and that's how the portfolio was behaving over those periods of time. And it was stock specifics driving performance, good quality businesses growing their earnings in excess of the market, and that getting rewarded, and not being thematic skews or having very rapid growth businesses or exposures into the likes of China in a very significant manner that led to the whipsaw performance. So mitigating against that.
Thank you.
Other questions?
Mr. Chairman.
Yes, sir.
I have a relevant question. It's just burned to ask, and I asked him on behalf of Mr. Benson. Rebecca, when you competed for the University of Tennessee golf team, did y'all ever beat Ole Miss's national rank, got the women's golf team?
I did see that in her portfolio, at her bio.
I would like to think that we did, but I'm not sure. Not certain. So yeah, you've got an excellent.
It may be the only thing that Ole Miss has won in the last century.
I know. Well, here I'm just pleased that our football team is finally showing up to play, because when I was at university, they were pretty dismal.
Thank you very much. That was very important.
I'm going to declare that out of order. Being the Bulldogs, Mississippi State, I just think that's out of order. But
Mississippi State doesn't even have a women's golf team. They just started having women's students.
Okay, we thank y'all for coming and spending time with us and explaining some of the issues that you've had over the last couple of years or so, and we appreciate that and the efforts. And any further questions? If not, we thank y'all for coming and being here with us.
Thank you very
Thank
much.
you very much.
Thank you.
And that's miscellaneous updates. First miscellaneous updates is just covering Valley Gifford. They had a few new promotions to their board of directors. Not much to speak there. It doesn't directly impact our portfolio management. And then on Fisher Investments, this is just information that the minority investment by a fully owned subsidiary of a Abu Dhabi investment firm called Advent International has been completed with Fisher Investments. Nothing to do with our direct portfolio management, but just informational.
Okay.
And that, sir, is all I have.
Okay, any further information to bring before the investment committee? Any by the ways? Mr. Higgins?
No, sir, just thanks to everyone, and then we start tomorrow at 10 a.m.
10 a.m. in the morning, so the investment committee is adjourned.
Thank you, sir.